Good morning, everybody. It's the 20th of October. It's a Monday. We've got a wonderful lineup for you. We're going to go through some big Asian moves. We're going to go through, of course, the regional banks, the story from last weekend. And the one, the only Chris Beecham is joining us to give us his week ahead as well.
Good morning.
How are we doing?
I'm very well. How are you?
Late night. He's in a bad mood this morning because he's hardly slept. So
I missed my stop on the tube. But it's good though.
How did you manage that?
I did because I fell asleep. Usually I wake up from Moorgate, but it was good because it's chucking it down outside.
Right.
So I didn't have to walk.
So you're on the tube for a long time then?
Yeah.
Yeah.
I get on right at the other end. Zone 8.
Wow, I didn't.
You know it was a zone 8, did you?
No,
exactly.
So where did you end up? Did somebody wake you up? Or?
No, I just woke up at Liverpool Street and then just got the Central Line. But it saved walking in the rain through Moorgate, so actually we worked out quite nicely.
Shall we have a little weather check this morning? We've got to look at it, don't we? This is the kind of morning that anybody who can work from home wakes up and they look out and they hear the rain and they think...
It feels like that in the office this morning.
Yes, I would imagine.
Everyone's gone, nah, can't be bothered.
So good morning to our social media team. Not that they'll be awake yet. When they're watching Trade Later with IG, then...
Trade afterwards with IG.
Yeah, good morning to them. Good morning to you all.
It's an issue why they don't like you, really, isn't it?
So who we got then away from the numbers? Andrew McKelvey saying, expect it to be a good day for defence holdings. Stop talking your own book, Andrew. I would never do such a thing. As they say, multiple sovereign AI products are in development and soon to be in deployment. Wow, that does sound positive, let's be honest. Funky Gibbon, good morning to you. Friar Tuck, Julian, I to Rock, and Donny. Let's see what is coming up on today's show. We got a special guest for you, not the one sitting opposite me. He is a special presenter, not a special guest. And coming up at 8:30, Imran, that's back from Credit Suisse Citigroup. The banks are in such focus at the moment, I thought I would get Imran back in. So Imran Laka joining us 8:30. We're going to be talking about all things banks, the debt cycle. We're going to be talking about options and how Imran is seeing some volatility plays at the moment. And then, where's Axel off to now?
He's in Japan. Just that must be why the Nikkei hit record high, because Axel's arrived in Japan. But yes, his ankle recovered in time for him to go to Japan, so he's gone there.
Business or holiday?
Pleasure.
So interesting.
Gone off walking in Japan or something.
Right. He does have some very interesting holidays.
He does. He's always wanted to go to Japan, apparently. So he's finally persuaded Mrs. Axel to go for there is one, to go to Japan. She wants to go to China again, apparently. So
right.
They've gone to Japan. So you get me doing Trade of the Week. Where's the dramatic music for that, you know?
Dun, dun, dun.
Yeah, exactly, that kind of thing. Halloween music. That would also do, yeah. Well, he's not... Anyway, sorry. I need to come up with one in the next sort of hour or so.
Let's go to overnight action and have a look at Friday's and the weekend's action, because you were certainly paid for taking risk over the weekend in the world of crypto. That's right, so the normal thing, everybody was scared to hold crypto over the weekend, so of course it's had a huge pop higher, not just yesterday, but also overnight as well. So we can go straight into a nice little Bitcoin. Oh, it's gone again since I first looked at it this morning. So we can see here, so actually let's take it back to the weekend before and we can put everything into. So here we go, there's the Friday night move and the Saturday morning, and you can see it. We are actually exactly where it had dropped to. Subsequently sold off during the week. There was some big selling during the week. Bitcoin taking it as low as 104. And then the pop-up there, you see back to 111,000. So we are, flying.
Storming recovery from Bitcoin, because it was very much... crypto winter, bad times for crypto after a huge rally.
Exactly.
And it comes off. Obviously, the volatility is a given with crypto. You have to remember this. And I think people seem to forget this really easily, which is odd.
Well, the vol has been taken out of it, though. Because
Well,
the,
yes,
the
it's
ETF
calmed
is-
down. If you remember in the good old days when it was sort of $4 or whatever, it was absolutely bonkers volatility. So yes,
Yeah.
the more institutional it becomes, the less volatile it has become. But it's still, compared to everything else, still more volatile, isn't it?
Yeah, especially on a Friday night.
Yeah.
When, with liquidity. As soon as the ETFs close, then boom.
Precisely.
Boston Frank, rich is a good name for an investment guy. Yeah, I haven't met anybody called Loss, actually. Or Poor. Standard and Poor's.
Yeah, Standard and Poor's.
Yeah.
Look what happened to them.
Could be R&P.
Rich and Poor's. Rich and Poor's. There we go.
Yeah, so Ethereum strong as well. You can see that. So Ethereum approaching 4,100. So yeah, nice little weekend.
Sea of
on-
blue across crypto prices this morning. Doesn't quite work as well as sea of red, does it? Unfortunately, but yeah, definitely.
the blue sea. And there we are with the same on the S&P 500. So it was up 50 basis points on Friday as we got through Friday without any more headlines, and the regional banks reported decent numbers. So regional banks up 1.7%. Zion's bank actually bounced strong. It was up nearly 6%, and Western Alliance up 3%. The KBW as a whole was up 1.7%. And yeah, we've got a bit of a graphic there.
Oh, a graphic.
Producer Phil tapping away, getting the specials up. There we go. All right, take us through that, Mr. Beecham.
Look at that, and that VIX, of course, hit. I don't know if I'll get up the charts in a minute, but VIX down 1.3%. Nikkei absolutely surging because the new, I can't say her name, I'm not going to, the new Japanese, you did it, you can say her name.
Yeah, Takaichi.
Takaichi looked to be confirmed in power, so 3.2%. Hang Seng up 2.2% off the back of Trump saying he expects to go for a jolly to Beijing to meet his favourite person
Well,
in the world
and
again.
Besant is going to meet.
Besant, yes.
Is it this Friday?
Yes, because there were comments on Friday, wasn't there? There was Trump comments about that he doesn't want tariffs to remain in place. And then Besant, they are talking to their counterparts now, we'll go and have a meeting. So again, it's the sign of talks, always gets the market rallying, and lo and behold, there we are. So
it's nice. So it's a nice positive start. However, I was talking to a friend at the weekend and wasn't happy because she was having to work all weekend as head of one of the fixed income departments at one of the big banks, because they have to do a presentation to the bosses this morning on all their exposure. So I would imagine that this is exactly as we'll be seeing across every investment bank, every private equity fund. Get your bloody house in order and tell me what your exposure is to these NDFIs.
yeah.
Because nobody wants another margin call type event
No.
with the movie rather than the actual margin call itself. That they get surprised what they've got on their books. So that's the whole weekend, all these banks are going to be getting out. Now, normally, that uncovers something, right?
That's the danger. If you go looking for stuff, you tend to find it, don't you?
Then you've got to take action, and then so do we see credit markets completely normalize, or is there a little bit of liquidity, pullback in liquidity there over the coming weeks? Who knows?
Maybe. I mean, this is echoes of 2023 in Silicon Valley Bank, doesn't it? And that's the sort of playbook that everyone goes back to. But of course, they have the processes in place to deal with it now, really. And as Jeffries was saying on Thursday, it looks like it was overdone.
Well, that was treasuries, right? that was not fraud. This is outright fraud.
Outright fraud, but it looks like it's a sort of confined to certain. It doesn't look systemic, put it that way. That was the key word, wasn't it, from 2023? Is it systemic? Is it the entire banking system? The answer was no.
Yeah, because it was a treasury position. But this time, First Brands has gone bankrupt and gone bankrupt with fraud, and everyone said, "Oh, it's fine. It's a one-off." Zion's proved it wasn't a one-off. Yeah. Western Alliance proved it's not a one-off. There are cockroaches out there.
There are, of course, and that's the concerns. But it was. I was saying to you before we started how sentiment shifted so rapidly to, and I was asked this on a radio interview on Friday, is this 2008?
Yeah, what were their line of questions?
It was the questions of talk about turmoil in markets this week, and is another crash coming? Is this 2008?
But yeah, I mean, it's so absurd. It's such a media.
It
thing,
is,
isn't it?
but it's and there was a big column in the Daily Mail over the weekend because I went to see my parents, and then my dad said, "Have you seen the column in the Daily Mail about this? Alex Brummer is another massive crash coming, this kind of thing." And
It's ridiculous. It
feels
doesn't have
very
to be
crashy. It feels very sentiment. It feels so.
That's just media, though.
But it's interesting how you've had a stock market that's gone up relentlessly for months, and then you've had one choppy week, and it was because you had obviously the Friday before was the first trade thing, and then it seemed to recover, and then it sold off again during the week, and you had 1 week of essentially sideways price action that felt quite dramatic, and suddenly the comparisons were coming round, and then you had a US banking crisis, and it was interesting how everyone's immediate reaction was to go to, oh.
Yeah, but let's take the sensationalism out of it, right?
Well,
You've got market all-time highs, and you've had abundant liquidity there for private equity to leverage up as much as they want. The question is, does that liquidity now slow down? It doesn't have to be a crash. It's just a slowing down of liquidity. And let's not forget that the US economy is AI and CapEx spend. Underneath the surface, clearly, there's some shit going on.
There is always something going on, and I think that the sensationalism is almost part of it. The way people are sort of immediately latch on after years that they're perhaps justified nervousness at record highs, and the sense that maybe it's running ahead of itself.
But the underlying economy is in recession. There's parts of it clearly in auto supply.
Parts of it are suffering. Yes, I think it's probably extreme to say. I think Lombard's been very good on this. That the US economy it's not just AI. There's more to it than just AI, because there's a lot more going on with the rest of the economy. Yes, there are parts that are suffering, but to say that GDP is being driven entirely by AI is probably a mistake. I think this is the point the FT made as well last week. I just think it was notable how you had those sort of comments and columns over the weekend.
Then you don't have to cut interest rates then, if it's
well, because I think that we are still living in the aftermath of 2020. That you had the economy shut down, then you reopen it, and you had massive job creation. Obviously, you had the inflationary move as well, and then it's just the rate of job creation was so huge that now it's slowed down, and the Fed is almost panicking in a sense about what they think is a stall speed in the US economy, because you've got zero job growth. Sounds very scary, understandably, but if that's simply the case, that it's a reflection of how strong job growth was 2 or 3 years ago, that it's perhaps natural that you have this hangover that we're still processing. The US economy is not at stall speed, and yes, the net job creation is not there, but it is not. We're not poised on the cusp of crisis, but it is necessary for the Fed to cut rates just to keep it ticking along. And I think it's, as we've said before, there are good rate cuts and bad rate cuts. I think we just about still fall into the good rate cut category here. Maybe if we get some more banking crises, it tips over into the other kind. But we'll have to wait and see with that.
Well, the spreads are starting to price in some kind of distress in the debt market.
Which, of course, is what you want them to do, to an extent. You don't want them to be blithely whistling past the graveyard. There's nothing wrong. Everything's fine.
But the next stop after that is that they have to stop QT. So it more like a 2018.
Well, yes, and then exactly, and there's the Fed responding. So it's also yes. I think the potentially stopping QT line didn't get as much play last week as it probably should have done. That the Fed is again prepared to provide the liquidity as well where it's necessary, which will then set off the whole argument about QE and etc. Are they supporting financial assets? But it simply is what it is. That they don't have to carry on with QT permanently. They can turn it on and off as needed, and if the time has come to turn it off or to stop doing it, I'm getting confused now on what they're doing.
It's just
then maybe it's necessary. Maybe it's good. I think it's always notable the way the VIX had surged to its highest level in what? I mean, looking at this on our platform, I think it's on full screen, but I did try to put it on. Oh, okay. Sorry, I apologise to the gallery. They were right. That VIX, the highest level there since the end of April, which seems quite bonkers.
Well, I think you're absolutely crazy. So you're getting a slowing jobs market, and now you've got a potential slowing of liquidity and financing,
which the Fed
of course the VIX is going to go up. You're
Well,
at all-time highs. You're
well,
going to want to
maybe.
take out insurance.
But again, maybe it's a reflection of how panicky people still are, and the fact that I know you're not a fan of the CNN Fear and Greed, but that went to extreme fear last week on what was just a choppy week after months and months of gains. I think shows you how people are still sort of jumping at shadows almost.
Jumping at shadows, you've got completely blind economic data. You have no idea what the job market's doing.
We don't know where the job market at the moment is. We don't fully know that. And obviously the CPI is delayed because it's Friday. We should probably do the week ahead, shouldn't we? But
yeah, that's a perfect intro into it.
Yeah, this is also the key thing that you've got. It's a week of inflation data, isn't it? Actually.
So UK CPI, we start off with Canada.
Okay, Canada first. So that's
Canada
interesting.
first. Is that you doing a promo for them?
That's me, that's my pro Canada, or loyal North America as we should call them, I think. And then obviously it kicks off again with UK CPI on Wednesday, probably going to make the Bank of England's life a bit harder because it's supposed to rise on most of those metrics. And Chicago Fed and existing homes. So no initial jobless claims again on Thursday. That is the expectation because they are officially delayed. But the others, I think, are still supposed to come through. And then it's the big one on Friday.
Dun, dun, dun.
Again, inflation rising in Japan. Another one to watch there. UK retail sales. PMI day as well. So busy day on Friday.
It is, isn't it? At last.
US. Flash PMIs across the globe. The key ones to watch the German manufacturing one, which isn't supposed to be great. UK PMIs. Slightly better. Some tiny bit of good news there from poor old Rachel Reeves.
Poor old.
I know people feel sorry for her. And then, of course, the biggie, CPI, expected to have risen a little bit, although core CPI holding at about 3.3. In fact, slightly down from where they were in August.
So there's a question around the playbook now as well. So, we've given up on inflation targeting. That's quite clear. Now happy to run at 3%.
Yeah, which maybe they're right to do. Maybe the 2% was the hang-up.
Well, then announce it. Don't stick with the 2% target that
Yeah, I mean, in the good old days, the Fed just used to raise interest rates and not tell anybody. And then sort of in the early 20th century, they just didn't do it. Didn't have an announcement. They just didn't.
Right.
So maybe they should go back to that, really. But yes, I suppose the inflation targeting, maybe they should look at 3% because 2% is arguably a reflection of what was the phrase for the Bank of England? The nice decade, wasn't it?
Which decade was that?
Non-accelerating inflation rate of unemployment, the sort of 2000s, the post 2001.
Right, okay.
Somebody on the chat will know what the phrase was about not inflation and not having an inflationary economy. But yes, so maybe the Fed does that. And we'll see where the CPI data comes in, particularly.
Right, and then who are we hearing from? There we are. So think of the blank Monday, and then the Tuesday. I'll show you there we go. So 21st is when we start. We get Netflix after hours. We get Coca-Cola pre-market, Lockheed pre-market, along with GM and Halliburton. Then you get Tesla on. Now is Tesla pre-market? It is, isn't it?
No, Tesla's post-market.
Tesla post.
So Wednesday evening.
I can never remember. Oh, yeah, of course, yeah. But and then Elon comes on with his conference call afterwards.
Yeah.
IBM, and then you've got Intel on Thursday, along with Ford and American Airlines, Freeport McMoran, and then in the UK, good old London Stock Exchange there on Thursday, along with IHG, Relics, Rentokil, and Unilever. So Thursday, quite a reasonable day for the FTSE actually. There's a few.
Yeah, it gets a bit busier, really, in terms of earnings data, so that's the one to watch. A few more coming through, Intercontinental Hotels and Unilever, so interesting dividend players there.
And then talking about dividends, Thursday dividends, you've got BAE Systems and Moonpig, that's a big mover. And then JD Wetherspoons.
Spoons comes out, doesn't it? So 250, so watch those names on Thursday.
Mark your card on Moonpig. We front page of the newspapers. We have, of course, it's all about Trump and Zelensky. A big argument again. Yeah. Heated debate in the White House as Trump tossed aside maps of Ukraine frontline.
Yes.
And told him he's going to get destroyed.
Yes, he seems to have Every time he gets on the phone to Putin, he seems to... Trump really still sort of has the opinion of the last person he spoke to.
Oh,
and this is what must drive European leaders mad, because you can go and tell him that white is white, and then he'll bring out Putin, and Putin will tell him that white is black.
Yeah.
And then you have to go back and do it
Or
all.
red.
Yes, and go it all back again. And so, yes, it was apparently a very stormy meeting. Profanity was used by the president, unfortunately. So it does not look to have gone well.
Language.
And then, of course, we've got, there Friar Tuck there saying that rare earth stocks still in focus. The Financial Times also has an article. If we can pop that, please, guys. Rare earth shares soar. US and China, of course, Pensana, remember that's included in that. Then we've got Thames Water. UK profit warnings rise as business blames trade tariffs and policy shifts. So that's basically along the lines of it's not just businesses worried about their spending now, it is also the consumer. You've got problems with consumer spending now as well, and that is hitting confidence. On the Times, let's see, we've got weak consumer confidence blamed for profit warnings, also running the same story. The media love it, don't they?
Everyone loves a profit warning. Get one from B&M this morning, actually, so we'll come to that later.
Oh, really?
Yes. And the CFO leaving
that's
on the same day, so they discovered a
Wow.
mistake. So that's
Oh, more fraud. I mean, sorry, more
not
mistakes.
fraud. You can't say that live TV. We've got
More mistakes. It's never a sign of a late cycle of an economy, is it? Fraud and accounting errors.
Exactly. Yeah.
Right, China. We've got a GDP number 4.8%. That was in line this morning.
China.
And,
Close to 4.8. Rachel Reeves would give her right arm for 4.8.
Oh, my goodness, I
Actually,
know.
give both arms for 4.8% growth, I should think. But yeah, there you go. The B&M news.
Right, so Mike Schmidt, CFO, was to step down after the troubled 7 million of overseas freight costs had not been correctly recognised when it updated the market. Is 7 million big in the grand scheme of things for them?
Well, but if you look at it's a 7 million cost, but then it means adjusted profit now supposed to be sort of 30, 40 million pounds lower where they expected. So it's had a nasty.
So it's a profit warning,
Yeah, that much is a. You always have this.
and they've thrown him under the bus.
I'm sure a lot of the viewers will get this when you're looking at RNSs. It's always the ones with the innocuous headlines that contain the shockers. It's always something like CEO had a nice weekend. Oh, and by the way, massive profit warning. This kind of thing. Update on something. Update on our new logo. And then, oh, and by the way, here's a profit warning. It's always the way with RNSs. It's becoming more and more difficult.
This is a 40 million pound profit warning that they're arguing is caused by a 7 million accounting error.
The numbers, I have to say, they don't really.
Oh, well, the market sniffed it out already, look.
Really, well, that's poor trading as well. But yes, it's terrible performer B&M, really, in a sector that's. I've never been a B&M. Have you been a B&M? I've never been in a B&M.
Boston Frank asking, what are Putin's terms? Putin's terms now is he'll give up the eastern part of Donbass if he's giving small areas elsewhere. And so that is Trump's terms now that he's gone with.
Yeah.
Trump, the special envoy.
Yes, Putin wants the Donbass and will give them tiny bits back, but they've not made any progress in the Donbass for months. And it's also, if you do that, you unhinge the entire defensive line the Ukrainians have constructed, so that there's nowhere they're giving this back.
No.
I think. Because it's interesting how Zelensky went to Washington. I think he offered him thousands of drones in return for Tomahawks, these cruise missiles.
Yeah.
And there was just nothing doing because of the timing of a call. And it seems that, unfortunately, to give Putin his credit, he knows he's not very good at getting Trump on his side, because we had reports as well about the Alaska meeting that came out about how Putin droned on for hours about his historical claims to the region, and Trump just lost it with him. But he is able to sort of, just when the president seems about to tip over, he can sort of knock him back into position and have another chat.
Yeah.
So it just goes on and on, really.
Nothing to do with photographs in Moscow back in 15 years ago. So 116 of you watching now. Are you subscribing and giving us a like? That would be wonderful. Give us the thumbs up there. And we shall go to a break now. We'll be back in 2 minutes with the opening bell as we get off and running Monday. It is a Blue Monday. We're looking up small as Rachel Reeves talks about incentivizing people to buy British. Do you like the sound of tax-free trading? Well, that's exactly what spread betting enables you to do. This tax-free way of trading lets you speculate on the price of over 17,000 financial instruments, like shares, indices, forex, and commodities, without actually owning them. With spread betting, you can benefit from both rising and falling prices, letting you find the perfect opportunity. So if you think the market's going up, you buy. If you think it's going down, then you can sell short. Not only is spread betting exempt from capital gains tax, but it's also commission free. All you pay is the spread. With us, you're not alone. You're part of a wide community of traders that you can learn from. We've got the experts, the tools, and extensive educational resources to help you on your journey. If you're not quite ready to trade with real money, you can always give it a go on a demo account. Open an account today, join the conversation, and be inspired to make moves. Welcome to The Art of Investing, a brand new podcast to help you achieve your investing goals. Join me, Rich McDonald, and my co-hosts, Mark Spice Holden and Chris CJ Fellingham, every Friday when we bring you updates from the markets and insights from our combined 100 years of investing experience. If you're looking for flexible ways to trade financial markets, whether you're experienced or new to trading, you've come to the right place. CFDs let you speculate on the price of financial instruments like shares, indices, forex, and commodities without actually owning them. You can benefit from both rising and falling prices across 17,000 markets, letting you find the perfect opportunity. So if you think the market's going up, you buy. If you think it's going to go down, you sell. When trading CFDs, you're trading on leverage. Now, leverage lets you trade bigger positions with less money up front. So this increases your profits on your trades, but also remember your losses are also counted. Right, we'll take a quick look at my portfolio then, see what we did. Remember, we traded on Friday morning. Still got the Diageo, so we're long some Diageo, we're long some British American tobacco on the defensive stance. And then for US-wise, still got Marvell, still got Nike. And then what was the other one? Short a bit of Rolls-Royce, long the Pfizer, short Rigetti. Rigetti, the CEO, so this is the quantum computing.
Oh, yeah.
CEO has sold all his shares. I mean, come on, if there's ever a sign.
That's going to be fun for the PR department this morning, isn't it, really?
Well, no, sorry, this was Thursday, so that's not new news, but Thursday. I'm short Starbucks. Short Starbucks, that is hurting so far. I'm short at 82. They're trading
It's a bit of a
85.
grind, isn't it, shorting Starbucks?
Yes, nice. Nicely done. I like that a lot.
Oh, don't go me gallery. This is the problem I have.
And then Whitbread. Yes, I wanted to cover Whitbread.
Shocker.
So let's do that in fast markets at 8:15. I am long Whitbread. I'm going to be buying more this morning. We got the details of a meeting with the management on from Thursday. got a good breakdown of everything that was said there. And yeah, I'm looking to pick some more up this morning. I've also bought some European banks on Friday. So European banks, just to remind you, UBS was down 7%, Barclays was down 5%. They are up strong for the year, so I'm not, not married to the position, but just for a small bounce, bought some of those. Right, what bell are you going for? Are you going for the London Stock Exchange
Is that one
bell?
approved? Is that the approved bell?
Yeah. Boise won't be happy, but...
I like a bell you use to summon tea or toast in the morning, isn't it, really?
What, from my mother? I used to, yeah.
Have my breakfast now, please.
Right, HSBC up 1.7. So there you go. The banks are recovering because we've managed to get through the weekend without any more headlines. New negative one. So Rolls-Royce, brilliant. There we go. There's my short, up 2%.
Where's the Axel quote for that one? Sorry. No, you lost it.
Funky Gibbon asking, will Rolls-Royce start to gain on Trump's position on Ukraine? Well, it depends. Depends how you take that, isn't it?
Yeah.
But the Pru up 1.5, NatWest up 1. Schroders, Scottish Investment Trust. Yeah.
History at 1.1%. Is that off the Galliford Try news, I think, this morning? The contract news for them, so that might be interesting.
Contract news and Vistry.
No, contract in Galliford Try, but I suppose there's a read across there, maybe.
Okay.
Spitballing on that news, but yeah.
Lloyd's up 1.4, NatWest up 1.2. So it is the banks leading the way and rollers, along with some of Barclays up 361. Then we've got mining stocks, copper. That's the other thing I've got. So I'm long copper, short gold and silver. That had a great day on Friday. Copper up 70 basis points this morning at 507. So we got Antofagasta bouncing. IHG up 30 basis points ahead of numbers this week on Thursday. Do you want to go through the loser?
Let's see what we've got on the downside. Oh no, train line delayed 2.4% down. I can't think of a better pun. I'm sorry, that wasn't very good. Hammerson,
Steaming this morning.
2%. 1.8% off on poor old Marks and Spencers and ABF. Is that
Marks?
Consumery focused this morning, isn't it, in the losses? Why is that off the Time story?
Yeah, but it's a bit of a weak story if it is, isn't it?
But yeah, across the board, Fresnel obviously down 1%, still feeling the pain of silver being a touch weaker.
Which one, Phil?
B&M.
B&M still an auction. That's why.
That's going to be fun.
B&M, I'm not sure there's a read-through to Tesco from B&M. Come on.
Markets need a reason for an opening drop, I suppose. But
yeah. Marks and Spencers had got back to £4. I hadn't realised that. That caught me unawares.
clawing their way back again, really.
Yeah, so that cyber attack that knocked them down below 350 has been completely forgotten about.
This isn't any rally, it's an M&S rally. So there we go.
Where is Whitbread? Whitbread up yet. Oh, that's a tight spread there. Could really do with
M&S, of course, setting those record highs, isn't it? No, sorry, not record highs, but multi-decade highs or whatever it is.
I'm going to put an order in to buy at £29, 500 shares of Whitbread. So there we go, 500 to buy at £29. Get that in because it's a bit of a wide spread at the moment. Not paying 8p IG. Come on, tighten up your spreads in Whitbread. It's disgraceful to drive a bus through that.
I had anyone that says that sometimes.
Right.
Old-fashioned phrase.
Let's have a look in Europe then. We didn't cover. My goodness, right. You've got a bottle of Creed at home, don't you?
Bottle of what?
Creed. Creed Aventus. It's the fancy aftershave.
No.
Oh,
no, I have the old-fashioned one. I have the really old-fashioned cologne.
What, Old Spice?
No. Oh, Spice. Wash your mouth out. No.
So, Kering has sold its beauty business to L'Oreal, and this includes Creed Aventus perfume. It includes the licenses for some of their obviously big names such as Valentino, Bottega, and Balenciaga. Those are now going across to L'Oreal, but Kering's got €4 billion in return.
Smells like a good deal.
It's a beautiful deal. And that'll go to paying down their debt. Their debt's around about 9 billion euros. It was a little bit of a concern there, obviously, with the slowdown in Gucci as well. Gucci perfume will go to Kering in 2027. So a good deal. But when you hear that they actually purchased Creed Aventus for over 3 billion euros.
When did they buy that?
Only 3 years ago.
3 years ago.
So this, I'm telling you, this aftershave though, oh Chris, if you have Creed Aventus on, it stops people in the street.
For a good reason, or do they just fall over because you?
Well, it
you
depends how much you put on. So I had a bottle of this back in 2016, and of course I would go to work. My housemate worked for BNP Paribas, but he was on the derivatives desk, so he didn't have to be in as early as I did. So he would sneak into my room after I'd left in the morning, go and put on my Creed Aventus. And it was only after a year and a half of living together that he admitted that he was doing it every morning. And that's how it went down so quickly. So as a leaving present, he bought me a spare bottle. So yeah, Keane Fitzgerald, thanks very much for that.
That's when you started weeing in the bottle.
Well, yeah, I should have, yeah, whatever his...
But, yeah, no, I'm not. I wear Trumper cologne.
But yeah, Creed Aventus, at that point, it was £100 a bottle. It's now £280 a bottle.
So you should have bought stacks of it. B&M open.
B&M is open, right? So a profit warning of around about 20%.
I suppose if you're expecting a profit hit of about 30 to 40 million, that is rather commensurate with where you'd expect it to be. Look at that opening gap. Oh no.
There we go. Oh no. Right, 177 now. Where? Oh my goodness me. Right, let's...
£6.50 in 2021.
Shall I bring that in?
That is what they call a dog. There we go.
I don't know.
I think.
People were so positive on this thing. Can everybody see where it's trading there? I know it's going to be low on that screen, but it's way down here. When did it last trade down here? Has it ever? Shall we do on to a weekly? Let's go on to a weekly chart. No.
Never? When did it list? Yeah, it's never been down here. And that, of course, is crucial because it's knocked you through those lows from 2014 and 2017. So that was your support gone.
I'm sorry, but look at that. Look at the fall already going into it. Is some of this not priced in? The problem is that when you've got an accounting error, people don't, they shoot first and ask questions later. Yeah.
Understandably, I think, really. I'm trading at according to Google Finance, it's trading at 5 times current earnings and a dividend yield of 8%. So that's...
Oh, I don't know enough about it.
No.
But...
You're getting an itchy buy finger, aren't you?
I am getting a real buy
finger.
You know
what happens to bottom pickers, don't you? But yeah, you can't help looking at it and thinking that looks ridiculously cheap. But
so tell me again what the
current yield, the current.
Let's have a look at market cap. I don't know the debt situation. The debt situation always worries me.
Market cap about 1.8 billion. Just looking at Google Finance.
Okay, and it's a profit warning of 40.
Yeah, you call it about. I think it was a 40 in the range. It was one of those with the range, so it's about 40 million pounds.
And so it's wiped off 400 million off the share price.
Yeah.
For a profit warning of 40 million.
Well, because I suppose as we were saying earlier, if you go looking for stuff,
yeah,
you might find it. And so if you've had a system error that delivers that kind of nasty hit, the risk is if you go looking, you might find others, which is maybe why the CFO's had to go.
Yeah. Yeah, I mean,
maybe you can read too much into that, but of course we know, and I don't know if this is the first profit warning or not from B&M.
Sorry, bounce 4%.
Profit warnings come in threes, don't they? So I don't know where we are with those.
Well, I think that, I mean, by the looks, it's had about 7. But this is meant to be the model. Maybe Andrew McKelvey, do jump in if you have a view here. He just bought some at 177. There you go.
Well, if you're prepared to sit on it and see what happens, it could be a really interesting move. Even if it bounced to those highs from the end of September, that'd be a decent bounce, wouldn't it?
Well, I was more thinking it bounced to sort of £2, £2.05.
Yeah, that's what I mean.
Yeah. Sorry, right. Yeah.
Right up to those, yeah. Before that, there was a gap lower, wasn't it, at the beginning of the month? So there we go. How many gaps? There's about 4 gaps on that chart. That's not a healthy price, actually.
Yeah. Right. Let's put in.
I do like to be Phil
an
Gary.
alert,
That's very true.
because we know that, look, the long funds will puke this today, because as soon as you have an accounting error, they just have to.
Andrew McKelvey says this is the 3rd profit warning. So on the old rule of profit warnings come in 3s. That has now hit the end of that rule. So if there's another one, it resets. But that is technically.
Right, 1.7. And Andrew paid 1.7. Oh, there's Ida Rock. Look at Ida Rock in at 177 and out at 186. Boom! In 2 minutes. Well done.
Take the rest of the day off.
Well done. Nice. Yeah. Okay, so I'm going to go 178. I'm going to put alert in there, just as a little marker. And hopefully that will jump up in my notifications some point in the next hour. Well, that's certainly a chart. That's an interesting chart. But what would you be able to guess that if you saw it in a few weeks' time?
Yeah, probably not. I'll have to keep an eye on that, Ren.
Right, coming up, guess the chart. We are talking. What country are we in? It's a US stock. Ready to guess the chart? Who's going to get it first? Or are you too busy trading B and M? Here it is. We'll see you after the break.
Ready to start and says slow down, let's guess the chart.
Welcome to Fast Markets. Today we're going to be looking at Whitbread. But first of all, Parky 1977. Good morning, mate. Yeah, cheers for that. Morning, folks. Rich's fantasy league team seems to be heading towards a relegation show. Cheers. Welcome to the show. Time do you call this? Market's been open 15 minutes.
Maybe he works in the social media team.
Yeah, working from home. What do you think the chart is there, people? I think David got it first there. R6 Senna shortly behind. Julian shortly behind that. Nailed it. Netflix. Look at how smooth and unvolatile it's been into... Non-volatile. Into numbers.
Yes.
Really interesting.
Yeah, and then sideways for weeks, isn't it? So it's interesting.
And The Diplomat is Series 3, The Diplomat's out.
Is it good?
Oh, it's brilliant.
Alison Janney, isn't it? She in it? West Wing fans.
Right, possibly. I never got into West Wing, funnily.
Didn't you?
No.
I didn't the first time. I watched it last year.
Right, Fast Markets, come on,
Anyway,
let's go. That is Netflix, but yes, ahead of numbers this week, there have been some good things. Now, Deutsche Bank had a meeting with Whitbread management last week, right? So we've got some really good steer on their thinking. They thought the move looked like it was overdone, right? That was the whole room looked like they thought the move was overdone on the downside. Remember, Whitbread dropped 11% on that set of numbers they produced. So current trading, London is especially strong. It was 100% capacity last Wednesday. Of the 98,000 rooms they're targeting, right? So they're trying to open 98,000 new rooms. There's only 1,000 rooms they don't have planning permission for already. So that looks like it is got a good chance of going ahead. Germany was cited as part of the weakness. To some extent, they saw it coming, softer demand in Q2, but of course that lapses the European Football Championships. So that makes a lot of sense. Of course, you would be lower year on year. They've just done a deal for 8 leases on hotels, which will come on next year. So the expansion in Germany is at full tilt. The losses there have been 50 million in 23, 33 million in 24, 11 million last year, and now looking for profitability into next year. So that German business in the growth phase is now coming into profitability. Cost inflation, you're seeing the usual stuff. There's a little bit of a warning there for Wetherspoons, Fullers and Youngs that the net cost inflation sounded potentially negative for them, for the pubs that is. But the inflation's come through in red meat and of course national insurance and energy, but they can mitigate the costs. So yeah, they are now where's they point to the fact they've done 43 million of cost savings in H1, and they're on course to do a further 250 million of cost savings over the next 5 years. Then you know, Deutsche go on to say, look, it's on 15.5 times 26. It's on 14 times 27. There's a 250 million buyback, which is 5% of the company. But there is a chance that they could go more aggressive if they see opportunities in share price drops.
Okay.
So you got a bit more aggressive, chance of more aggressive buyback in the short term. And so I think this is a good opportunity. I'm looking, it's unfortunately, it's up 20p today, but I'm certainly looking to grow my position
Share price
there.
has gone sideways for 5 years, isn't it? It's a problem, really. It's just lost a catalyst. Wasn't this Fast Markets? Was this a Whitbread special?
So I thought that is one of the most interesting things in the morning. What stock are you going to talk about, Chris Beach? Come on.
We should do Galliford Try since it's moved on a contract. with
Never
us.
heard of it.
No.
Something else.
House builders. Up 2% this morning. Look at that. Let's get... Where's Galliford?
Yeah, nobody's ever heard of it.
Nobody's heard of it? Nah.
What about your big US stocks? Anything there that you want
We
to...
should talk about Netflix ahead of earnings, shouldn't we? What's going on with Netflix?
Right.
And Tesla. I'm sure they'll be baying for interest on Tesla this week.
Yeah, Netflix, it's a very...
What's the
these
expected move for them? Do we know?
the ads have really started to come through. And remind me, one of the big companies just advertised for the first time. They've done a deal there. And I see limited downside in this on numbers.
It's expecting to see revenue grow 17% over the year, which would be up from the 15% recorded in the same quarter the last year. So it should be a fairly strong quarter coming through from Netflix. I don't know if you've got the expected move. Have you got that?
Yeah, just getting up my tasty trade.
Let's do that. I'll move on to Tesla numbers as well. Yeah.
Right, so numbers are on. Is it tomorrow? Tomorrow after the close.
For Netflix, yeah.
Right, so that means we're looking at. We've got a $94 move. Wow. So we're talking 7% expected move.
Chunky. There you go.
I would happily sell a put there down 7%.
It looks a bit.
Maybe I'd chicken out and go down 10. But yeah, I'd fancy selling a put down 10 to buy calls up 5 to up 12. That's the kind of thing I would set up.
Yeah.
On that big of a move.
Bit of a coil spring. Yeah.
Right, gold. What are you doing on gold at the moment, Chris?
I like the fact that the chat are dragging you because they're mentioning how much they like Galliford Try. So there you go. That'll teach you, won't it?
Yeah. Who
Turns
moved?
out they're all Galliford Try nerds on the chat. So there you go. Teach you.
Was this called something else? Never heard of it in my life. I only ever traded proper stocks.
Oh, dearie me.
But was it called something else?
It may have been. Maybe something. I don't know.
Right. I saw a very sensible comment in the Wall Street Journal over the weekend. So let's hear your opinion on.
I can't remember what I said. What did I say about it? I said
he's
all I
given
said
interviews
was
to the Wall Street Journal, and he can't even remember what he said.
It was a long time ago. All I said was the unstoppable rally seems to have hit a speed bump, and this is the thing, isn't it? If you look at that candle, you think, is it going to care? Does it finally care that it's sort of hit an air pocket? Have we got anything more fundamental behind it? That is probably the definition of parabolic move, and as the old saying has it, they don't correct by going sideways, but you might lose a lot of money trying to call that top in gold,
or make a lot of money.
Or you might make a lot of money with it coming down 2%. But if everyone else decides to jump back on board that could be really interesting.
I think it's more the actual technicalities of the market itself at the moment that's really interesting.
In silver.
There's literally a physical shortage, which is bonkers. But do you know where the physical shortage has come from?
No.
It's the ETF providers. You're seeing such huge demand in the ETS for these things which some might call speculation. The ETF providers are having to go into the physical market, buy the physical, and it's just there's not much there.
So that's playing a part in that move higher.
But that also means if a central bank somewhere decides just to put a little bit into the market and you start seeing ETFs selling, then this thing collapses. Because then it should never have been up there, and you've got forced sellers. So that's how you get a 10% move down in silver.
Yeah. Which can happen very easily because you are dealing with gold's volatile cousin at this point, or brother. Cousin, brother, doesn't matter. But when gold moves, silver's bound to move even more, I think is the way to look at it. And you wonder how much of that will be a connection with them, maybe with crypto as well. But maybe that gives crypto more of a boost, given it starts to recover.
Yeah, that's the interesting thing, isn't it? I mean, there's not often I would say I'd rather be in Bitcoin than gold, but now is actually one of those times.
Yeah, well, even Power calls it digital gold, so there you go.
Or somebody else said that, what was it, the weekend? So if Bitcoin's digital gold, then if you're going to the safe haven of Bitcoin, what's that? Or gold is now physical Bitcoin.
Physical Bitcoin. You could annoy a lot of people calling you physical Bitcoin. I suspect we should start doing that, really.
Yes, that always hits a mark. Right, B&M, where are we then? They are 190 in volatility on the upside.
Coulda, shoulda, woulda. Gaps do get filled, as producer Phil rightly noted, but Phil says they get filled. Yeah, there's a jack there.
Knocking 360 million of market cap off for a 7 million accounting error. Sometimes it's just too obvious.
Always obvious with hindsight. It does seem like a very dramatic reaction. But then if you've got the CFO going, the bad news is all there, isn't it, really, to build on that move? So.
Yeah. Right, it is 8:26, so we've got Imran coming up in the next few minutes. So we're going to go to a break. We're going to relieve Chris of his duties because he has to go and find
half an hour.
A trade of the week in Galliford Try.
No, by B&M. Oh, wait, that was the one we missed. Sorry.
Good stuff. Right, we'll see you in 2 minutes with Imran, my old colleague from Credit Suisse. He's also been round a few other banks, and he certainly knows his way around the banking system. So we're going to talk about what on earth happened last week, coming up in 2 minutes. Do you like the sound of tax-free trading? Well, that's exactly what spread betting enables you to do. This tax-free way of trading lets you speculate on the price of over 17,000 financial instruments, like shares, indices, forex, and commodities, without actually owning them. With spread betting, you can benefit from both rising and falling prices, letting you find the perfect opportunity. So if you think the market's going up, you buy. If you think it's going down, then you can sell short. Not only is spread betting exempt from capital gains tax, but it's also commission-free. All you pay is the spread. With us, you're not alone. You're part of a wide community of traders that you can learn from. We've got the experts, the tools, and extensive educational resources to help you on your journey. If you're not quite ready to trade with real money, you can always give it a go on a demo account. Open an account today, join the conversation, and be inspired to make moves. Welcome to The Art of Investing, a brand new podcast to help you achieve your investing goals. Join me, Rich McDonald, and my co-hosts, Mark Spice Holden and Chris CJ Fellingham, every Friday when we bring you updates from the markets and insights from our combined 100 years of investing experience. If you're looking for flexible ways to trade financial markets, whether you're experienced or new to trading, you've come to the right place. CFDs let you speculate on the price of financial instruments like shares, indices, forex, and commodities without actually owning them. You can benefit from both rising and falling prices across 17,000 markets, letting you find the perfect opportunity. So if you think the market's going up, you buy. If you think it's going to go down, you sell. When trading CFDs, you're trading on leverage. Now, leverage lets you trade bigger positions with less money up front. So this increases your profits on your trades, but also remember your losses are also amplified. so be sure to manage your risk. With us, you're not alone. You're part of a wide community of traders that you can learn from. We've got the experts, the tools, and extensive educational resources to help you on your journey. If you're not quite ready to trade CFDs with real money, you can always give it a go on a demo account. Open an account today, join the conversation, and be inspired to make moves. Do you like the sound of tax-free trading? Well, that's exactly what spread betting enables you to do. This tax-free way of trading lets you speculate on the price of over 17,000 financial instruments, like shares, indices, forex, and commodities, without actually owning them. With spread betting, you can benefit from both rising and falling prices, letting you find the perfect opportunity. So if you think the market's going up, you buy. If you think it's going down, then you can sell short. Not only is spread betting exempt from capital gains tax, but it's also commission-free. All you pay is the spread. With us, you're not alone. You're part of a wide community of traders that you can learn from. We've got the experts, the tools, and extensive educational resources to help you on your journey. If you're not quite ready to trade with real money, you can always give it a go on a demo account. Open an account today, join the conversation, and be inspired to make moves. Welcome to the Art of Investing, a brand new podcast to help you achieve your investing goals. Join me, Rich McDonald, and my co-hosts, Mark Spice Holden and Chris CJ Fellingham, every Friday when we bring you updates from the markets and insights from our combined 100 years of investing experience. Hello, welcome back. We're here with the one, the only, Imran Lakha. We've just been talking surnames. Imran and I used to work together at Credit Suisse, and then you went onwards and upwards into the American banks, the safe ones.
Yeah, the ones that survived.
Yeah.
Although just about survived. I was at Merrill, remember?
So that was, you were at Merrill's in 08.
In 08, yeah. And we, it was when Lehman was about to go, and Merrill would have gone if Lehman's went as well. But Merrill got taken out by Bank of America, and we got, it's funny, we got saved. But the irony was, all the people who were at Lehman's, they kind of got saved as well, because Nomura came in and bought all the banking part of
It was a recruiter's dream, wasn't it?
It was unbelievable.
And then Barclays, half of them went to Barclays, and well, over half went to Nomura, I guess.
Yeah.
But what was it like when that announcement came out on the Sunday night that Bank of America were buying Merrill Lynch?
Well, yeah, it was a relief, right? Because you didn't know what was going to happen.
Was it a surprise?
Yeah, I mean, they kept it fairly quiet in terms of, like, everyone on the floor didn't know. Right. It was a fairly, I mean, you would have had to be very senior to, like, know what was going on.
Yeah.
Right. Wasn't quite that senior at the time.
It was, I mean, it was certainly a frantic weekend, wasn't it? And so I was speaking to a friend, and they were annoyed. Didn't stop them going out to Kensington Roof Gardens on Saturday night, but they were annoyed that they were having to work all weekend to get all their exposures.
Yeah.
And so this morning, the investment banks, they're going in reporting all their exposures to the big bosses because of this regional bank turmoil. The small panic in regional banks.
Yeah, so like the regional bank sector in the US was down like 6% in a day, which is quite a chunky move.
Yeah.
and credit concerns coming back and stuff. But the thing is, we've seen so many of these little credit blow-ups now since '08, and the authorities are so fast to plug the holes now. So it's quite hard for it to turn into anything too sinister, I think.
Definitely.
Yeah.
But then you do have stocks such as Barclays up 33% this year, Standard Chartered up 40%, BNP up 20%. So they have had big moves, albeit they've got perfect conditions with interest rates.
Yeah, and the big banks are somewhat insulated, right? It's really the regional banks which you're a bit more concerned about.
Yeah.
That they've got skeletons in their closet kind of thing. But the too big to fail type banks, I think, are fine, right? Like the big US banks did well as well in earnings last week.
Although Jamie Dimon clearly peeved that he ended up taking $150 million hit in one of these things, But so we've seen this before. We've both experienced it. It doesn't feel like there's a subprime-esque problem, but that's not necessarily going to be needed just to take the S&P. Are you surprised the S&P is as high as it is?
I mean, when you're driven by rates and liquidity, like we have been for so long, we are cutting rates at a time where inflation is not low, right? So it's kind of, they're just running it hot and asset prices are reacting basically, right? So, I think I would be more surprised probably to see 6,000 on the S&P than I would to see 7,000 by the end of the year, right? Because we are in that world, right? Like they are, they should be probably more prudent about inflation, but they don't seem to care that much because there's so much pressure coming from Trump to bring rates down. He's bringing all his people into the Fed as well, right? And now you had Powell, right, talking about it last week about balance sheet, slowing the pace of balance sheet reduction, which was effectively dovish, right?
Well, I assume that's because they'd already told him.
Yeah.
The regional banks had already had to tell the Fed what they were about to announce.
Yeah. But again, that's a dovish comment, right? So it's kind of, whilst rates and liquidity are supportive of the market, it's hard for the bears.
Yeah.
Very hard for the bears. That's not to say you won't get these little corrections, but they're just flash in the pan type moves that literally they last a couple of days. And if you don't monetize all your protection, it's gone, right?
But that can be very, it pays off well, doesn't it? The chance to monetize that because we're at the levels that we're at, because vol was so low, you can get a bit of an explosion.
Oh, for sure. I mean, when volatility gets cheap, and options give you great leverage, right? And when you time it well, I mean, we had a 3% down day, which we hadn't seen in how many months, right?
Yeah.
So it's the biggest drop on the S&P on that Friday when Trump came in with his tariffs again, right? Finally, the market cared again, and the leverage you got on any S&P protection was amazing, but you 2 days later, the market was back at 6,700, right? So
it was crushed again.
Yeah, so it's kind of, you've got to be pretty fast to trade that. And the market's kind of figured that out as well, which is why the vol is quite high, right? It does pop a lot. The VIX got to 29 last week.
Explain to people what the vol is.
Just how much volatility itself moves, basically, right?
Yeah.
So if you look at, there's a measure called the VVIX. So everyone knows what the VIX is, right? Which is the S&P volatility, effectively, right? And that got as high as 29 last week on this regional bank wobble. But by Friday, it was back to 20 pretty much, which is a pretty big swing from 29 back to 20.
Yeah.
But the thing that kind of reflects that volatility of volatility is the VVIX. And the VVIX is up at something like 120, which is pretty high, right?
Wow.
So it gets maybe as low as 80, the VVIX.
Okay.
But right now, it's about 120, which is pretty pumped.
I was warned off. Actually, probably when you were still at Credit Suisse, I was warned off trading vol of vol. That was the sort of widowmaker,
Well, I think the widowmaker is being short a load of vol, right?
Yeah.
Because the amount you can blow up on that is quite spectacular, right? So selling calls on VIX, for example, right?
Yeah.
As a retail trader, you'll look at calls on VIX and think they're super expensive, right? But that is how you blow up your account, basically, right? So there's loads of there's not just retail, there's loads of hedge fund traders over the years who've thought they were smart selling really expensive VIX upside, And yeah, whilst nothing happens, it earns you amazing time decay and it works really well.
Yeah.
But you know what? Once in a blue moon, when it goes, it wipes you out. So it's not something I would ever recommend doing.
One of the recipients of running the economy hot has been gold, hasn't it?
Oh my gosh, yeah.
Go on, take us through.
Gold is a sort of asset that normally moves about 10, 15% a year, right? This year it's up, what, 50-ish, yeah? That's spectacular. A 3 sigma move on a long-term basis like that. All these long-term RSIs and stuff are in the 90 region. This thing, when it broke out of that range, it was in a range for about 6 months, right? Mm-hmm. When it broke out that range, it took out 3,500. It just flew. I mean, it surprised me. I was waiting for that break, and I jumped on that break, but I got out I started getting out at 3,800 because I was like, once it breaks that range, the measured move to 3,800 was the obvious target. And then 2 weeks later, it's at 43. You're like, what the hell? So it's gone a bit nuts. I do think it's overreacted, but you know, it's been a combination of China buying relentlessly. People have been talking about that's the real bid that just doesn't seem to care or what the price is. Yeah. But it's turned into a momentum trade now as well, right? So all retail have stepped in buying ETFs and
I think
stuff.
that's what it is. That's the second kind of leg up that it's had as
yeah, momentum chasers, for sure. Right. Yeah. So whereas AI stocks were the momentum trade, now it's gold and silver, right? So there will be a point though when that momentum trade kind of unwinds and it rotates to something else.
Yeah.
Right. But
what do you think it'll take for that to happen in gold? What stops this this craziness?
It's a good question, right? I mean, is there a point where China just take the foot off the gas a little bit? I mean, I think you kind of need that really, because if they're the main driver, but you might get a short-term correction, like from a bit of a momentum unwind, right? Where a lot of retail types have bought it thinking it only goes up, and then they get stopped out, right? But there will probably then be a load of demand that comes back in from the likes of China and from whoever else is accumulating, because it's a de-dollarization trade essentially, right? It's like,
well, that's what I wanted to get into.
So it's like when Ukraine-Russia kicked off a few years ago, and Russia's kind of treasuries got seized, the entire world looked at that and said, okay, we're all parked in treasuries in our dollar reserves, and these guys can just like seize them. We need to be rotating into something that doesn't get seized, right? That we can hold away from the US. So gold became that alternative, right? So
and that was China's real kind of wake-up moment. And
so everyone, so see, a lot of central banks have started kind of moving away from treasuries and into the dollar. And then on top of that, so not only central banks doing that, which it made sense, but then investors, smart investors, macro investors realized that kind of the policy mix was not great for bonds, right? And so it made sense to rotate out of bonds and into precious metals as well from a asset allocation perspective as well. Yeah. And that has been picking up steam as well in the whole asset class, in the whole asset management.
Let's have a look at the 6 months then. This is the iShares gold ETF. And you can see there right from the Fed indicating that, you know, rate cuts were coming back in August. Then that's been it. So Jackson Hole that sent us into overdrive. Mm-hmm. But nobody expected that
parabola.
Yeah,
it is quite crazy just how steep that is. But you know, if you've been long it, congratulations. But I think you'd be mad not to be putting some hedges in place now, right? You know, because like how, you know, you probably didn't allocate whatever percentage of your portfolio into gold thinking it's going to be up 50% this year.
Exactly.
So you kind of need to just be a bit like prudent and say, I've made way more than I would normally make on this allocation. Mm-hmm. I either need to dial it down a bit or I need to put some hedges around it, right?
And you are the hedging expert, of course. So Imran, let's just show everybody here. So Imran, his business is called Options Insight. He first taught me about options back in 2005. So yeah, certainly well placed.
2005. My God, that shows how old we are.
Does, doesn't it?
Yeah.
And so we see here the Alpha Pod. What's the Alpha Pod?
So that's our community, right? So basically it's a global community. So people from all over the world join it and they get access to my Discord server. So, you know, that's where we have lots of channels talking about lots of different things. And what I'm essentially doing is trying to teach people how to trade options like a professional. And so what I do is I break down the trading strategies that I employ myself with my own money into different categories. So directional trades, those are called delta trades.
You can take that down now. Show Imran in his full glory there with the stash on.
Yeah, I look a bit different from the picture now. But so we have directional trades. So when you're trying to get leverage to a directional view, you can use options to do it, and you can use various option structures to do that, depending on where the vol is and where the surface is and what is optimal. Then you've got theta trades, which are income generation trades, like call overwriting that I'm sure we've talked about before. And there's like funky stuff that you can do, like if you think the market's going to be range bound, you can do iron flies, iron condors to make money from a range bound market. So those are very popular, especially in the retail zero DTE space right now.
Oh my goodness.
Then we've got Vega trades, which are volatility directional trades. So if I've got a view on the VIX, for example, how do I express that? And using options usually on the VIX, so vol like we discussed, but in a safe way. And then finally hedging, which is a big one, right? I mean, that's the reason options were invented in the first place, was for hedging purposes, right? So
it wasn't for punting zero TT all in.
No, the world's moved on, but originally it was for hedging. But the idea is showing people how you can hedge your core holdings, like gold, for example. Gold has rallied so much. You might not want to sell it because you're like, why am I going to sell this? It's working, but it's hard to not think there's going to be some kind of pullback in the next couple of months, given how overbought it is, right? Yeah. So what you can do is you can sell upside calls, maybe 4,800 calls or something, and you can buy a put with the same premium that you receive.
Let's look at the IG option stream on gold then. So how far out would you go then?
Probably 2 months, right? So December.
Okay, so
I mean, that one actually expires 24th of November. That's only a month, right?
Yeah.
So maybe go a bit further out just to get a bit more juice out of those calls.
Okay.
And then where are we trading? We're trading, I don't know where the future is for that particular expiry.
It is 4312.
That's where the future is, yeah?
Yeah.
Okay. So then, push it a bit further out. So what do you get for that 4,800 call?
65.
Yeah, so you're getting about 1.5%-ish for that, okay?
Okay.
Right, and then what put can you buy for that same premium?
You can buy a 3950, 3,950.
And see where the vol is on that. The vol's 20...
22 and a half.
And what's the vol on the call?
24.
Exactly.
28.
So in gold, you have upside skew, right? Which you don't have in equities, right? In equities, you always have downside skew. So the put vol's higher than the call vol. And so when you need to hedge your equity exposure, you're kind of paying up for that a little bit, right? The beauty about hedging your gold exposure is you're not paying up. They're giving you some edge because they're paying up for those upsides because of that explosiveness that it can have on the upside. But once the move's already happened, you're kind of like, you're getting a really decent benefit for that, right? So that's a nice way to protect the exposure, basically. Now, you could do a bit more funky stuff that, like put spread collars, where you don't buy a put, but you buy a put spread instead.
Okay. So take us a bit closer to the money on the downside.
Exactly. So instead of buying that 39.50 for 60 ticks, maybe you buy the 4,200, right, for 150, and then you sell something lower down. Maybe you sell the 4,000 against it. So that's only cost you 75, right?
Yeah.
So you're so it's pretty much spending close to zero, and you've got protection down to 4,000 out to Jan, right? And if nothing happens, you didn't really spend anything, right? If the market keeps rallying, you've made peace with the idea that you're going to get taken out of some exposure at 4,800, which is another 10 plus 12% away, right? And then you're looking at a 62% return on the year, assuming we're up 50 already. And if you get the pullback, then you can monetize your protection. So you don't have to sit there and wait till expiry. Once this thing gives you some money because you get a pullback, you can just unwind it and take whatever you made, basically.
And that's literally about a 7% pullback, which is exactly what we're talking about. It would make sense. I don't think anybody would be surprised if gold was down 7% over 3 days in the coming weeks. Yeah,
and the beauty of a put spread collar structure, that's what that's called, is that it's a short vol structure, right? Yeah. So if vol goes lower, because vol has doubled in this move, right? Vol's gone from 15 to 30 pretty much. So if vol pulls back to 25, you actually benefit because the price of this structure will go up, right? Yeah.
Awesome. So that's on gold. What else are you looking at the moment? That's jumping out to you on the option side.
What have I got on right now? I mean, apart from I've been hedging a bit of my semi exposure. I've got positions in Intel and Taiwan semi and stuff like that. So
Intel reporting this week as well.
Yeah, so I've been doing some risk reversals on those as well. And then just in terms of
So let's look into Intel there, because it is one that we look at quite often on the show. So there is the daily, and of course this is really interesting vol-wise because it had the big drop last year, and of course now we've seen everybody and their uncle taking a potential stake in the company.
Yeah, exactly.
So they've got no liquidity issues anymore. So what do you do if you see it up at 37?
Well, I mean, I was buying it when it started to try and break that range to the top side at like 20, what's that level?
26 to 28?
Yeah, so I was buying it around 26, 27, right? And it was like so many false breaks, but I held on to it because I didn't buy options, I just bought Delta One, right? Just shares. Now that it's popped this much, I'm kind of like, okay, I don't really want to sell my shares, but again, I'll do the same thing, I'll protect them. So I think I bought like the 33 put and financed it with some 45 call or something like that, basically.
Right, okay.
Yeah, so I've got that to November expiry. So if it does have a pullback over earnings, then great. If it takes me out at 45, don't really care because I bought it at 27.
That's the last thing you care about.
You know what I mean, if you bought it at 27 and it takes you out at 45, I think you'll take it, right? So that's quite a nice trade. But it's like the onshoring trade, isn't it? It's like Trump wants to onshore manufacturing of semis.
Yeah.
And so they're going to be supported by the government in some way, shape or form, right? So you probably would buy pullbacks, but I just think buying it up here, I probably wouldn't chase it up here.
And what about TSMC then? Are you thinking more that they suffer from?
Maybe. I mean, I think you saw the price action after earnings last week, right? They had record earnings again, and it kind of opened up and only traded down from there, right?
Yeah.
So when you see bad price action on good news, it makes you wonder, is this thing a bit toppy now, right?
It's certainly, I mean it.
Yeah, I mean, I think I've had it for like
semi
200% basically on my shares on that thing, right? So it's kind of like, again, I don't want to sell something that's up 200% because it's like a long-term hold and a theme that's been in the book.
Yeah.
But at some point you got to say, okay, price action stinks on earnings. Let me put a hedge in place. So I've got December risk reversal on that one in case this thing wants to roll over a bit.
And risk reversal
is that still call buy put? Exactly. Yeah. So those are the hedges that I've got in place. And then in terms of longs that I kind of have put on using options recently, like the Delta trades that I was talking about, I've got some longs in the cannabis sector.
Oh, right. Oh,
Yeah.
that's a new one for us. I don't think we've ever covered the
Because it looks like the Trump administration's going kind of hell for leather on trying to push that and like deregulate that basically. And it's actually been in a long-term downtrend, but it's showing signs of an uptick, right?
And then, so this is just an index that IG put together.
Oh, okay.
So the cannabis index.
Yeah.
But do you go single stocks or do you go on any?
No, I just stick with the ETFs. I did some ETF call options,
Right.
sort of medium-term ones, right? And the solar sector as well is quite interesting.
Right.
Because the idea, and these are longer-term trades, so they might take months, if not years, to play out, right? So you kind of don't want to go too short-dated with those options, right?
Okay.
But if you zoom out a bit, so you can see a much longer-term chart, that's been even longer, right? How far back does
Way
that go?
back. Well,
Okay, that's pretty good. Yeah.
Go to weekly.
Yeah. So the idea here is that this sector, that's First Solar. I've gone for the ETF.
Ah, right. That's why it looks
TAN,
different. Right.
for the TAN ETF. Yeah. But the idea just being that all of this AI energy
Tan,
demand.
as in get a suntan.
Yeah, exactly. Yeah.
That's brilliant. These are genius. I wish my job was coming up with ETF names.
I do love some of those names. They are hilarious.
Yeah.
But the idea being, if this AI revolution or whatever you want to call it needs a ridiculous amount of power to drive it, right?
Yeah.
And China have been dedicating a lot towards building out their solar energy, right? So everyone's kind of going to follow suit, right?
Yeah.
To build that out. So, because everyone's going crazy for nuclear, but how long does it take to get a nuclear reactor online, right?
3 years at least.
10 years probably, right?
I think, well, the mini ones.
Oh, maybe the mini ones, yeah. But that's the point. So there's going to be a need for more solar in the energy mix.
Yeah.
And so, you know, Trump, when he first got in, he was like anti-alternatives, right? Anti-renewables. But there'll be a point where there's this big U-turn on solar because they'll realise that they have to have a lot of solar in the mix, basically.
Yeah.
Right.
So this has it's just starting to show some life, isn't it? After
Exactly. Yeah.
sort of a few months of not doing much. Okay.
So you know, for the longer term call options, you want to look for things that have been in the doldrums for a long time, but are now starting to come alive, right? They're starting to turn. The vol's not crazy expensive, right? On the cannabis sector, vol's expensive because that thing can do 20% in a day easily on a piece of news. But in the solar sector, vol's in the 30s, right?
Okay.
So that's really quite cheap if you think of it on a long-term basis. If you think the sector could 3 to 5x over the next year or 2 years or something,
Wow.
then a 30 volt doesn't feel too bad, right?
Right, we've got the US pre-market section in a few minutes' time. So I think we'll go to a break. Imran, do you mind staying around for US Open?
Sure.
Not 2:30, don't worry.
Yeah.
2 minutes, and we'll be back with you, and we'll go through some of the US stocks as they're showing that continued strength this morning after a rally on Friday. We'll be back in 2. Do you like the sound of tax-free trading? Well, that's exactly what spread betting enables you to do. This tax-free way of trading lets you speculate on the price of over 17,000 financial instruments, like shares, indices, forex, and commodities, without actually owning them. With spread betting, you can benefit from both rising and falling prices, letting you find the perfect opportunity. So if you think the market's going up, you buy. If you think it's going down, then you can sell short. Not only is spread betting exempt from capital gains tax, but it's also commission-free. All you pay is the spread. With us, you're not alone. You're part of a wide community of traders that you can learn from. We've got the experts, the tools, and extensive educational resources to help you on your journey. If you're not quite ready to trade with real money, you can always give it a go on a demo account. Open an account today, join the conversation, and be inspired to make moves. Welcome to the Art of Investing, a brand new podcast to help you achieve your investing goals. Join me, Rich McDonald, and my co-hosts, Mark Spice Holden and Chris CJ Fellingham, every Friday when we bring you updates from the markets and insights from our combined 100 years of investing experience.
Around on that.
How are we doing? We're back. We're ready for the Open. We've probably just got 30 seconds left. We're going to get you ringing the bell, Imran.
Hold on then.
30 seconds time. So we're going to have a look at earnings, what's coming up this week, if there's any plays into earnings, of course, Netflix and Tesla. But first of all, we're going to look at the all sessions and just see after, of course, that big move over the last few days. Not yet, Tom. Get it back down. Go on. Wait for 9 a.m. Wait for that bell to ring. And yeah, we'll see if how the recovery is going on this morning, including TSMC and Intel that we have just looked at. Go on. Bet you never thought you'd be ringing the opening bell, eh?
No, it's exciting. It's a highlight.
Right, so off and running they are. Imran, take us through what's some movers and shakers.
All right, what we got? 1.5% rallies out of a lot of these names. Big tech's going to be interesting this week. Like you said, Intel's got earnings, Tesla, Netflix, etc. Tesla is still pretty close to the top end of the range, right? At 440, 450.
Yeah.
I don't know. I struggle to see how Tesla earnings is going to be that bullish.
It can't be, right?
Yeah, I do struggle because, you know, they always rally on optimism, but they never really deliver on the numbers, right? So again, I mean, it might well be that earnings disappoint, we have a little pullback, and then it gets bought again. That's what typically happens, right? So I've been looking at some trades potentially on the option side on Tesla.
Okay, so let's have a look at Tesla options then for the week. Here we go. Right, so we got a daily one. We're now doing daily single stock options
Oh, really?
on the Max 7.
Oh, wow. Okay.
Hey, there's some fun for you to have.
Not my typical. It's not my typical instrument of choice.
Yes. Right. Excuse me. The options then. So this is the Friday expiry. So this is what we've got.
Yeah. Okay. So that captures the earnings, right?
Yeah.
Yeah. Exactly. But then have you got the one that expires the week after?
No. Then it goes out to November.
Ah. Okay.
Yeah. So I can get Tasty up if you want to look at that one. If we just take the chart up a second, please, guys. Thank you. Let me put my password in for my
So the way
Tasty
my playbook usually for earnings is to try. Like the thing about options is that they help you pinpoint what the implied move is for a name on earnings,
Yeah,
right?
okay.
So like options volatility normally trades at a premium going into earnings. The reason being the market expects a jump on earnings, right?
Yeah.
So by looking at the different volatilities between different expiries, you can imply what the move is, right? So I think the implied move for Tesla is somewhere like 6-7%.
Okay, let's get it back up. Right, so we got the weekly this week is expected a $34 move, and then the week later, $43. So that's 10% that would be, isn't it, for the week later?
Yeah, so but for this week is about 7%, right? Ish. Yeah, exactly. So a 7% move on Tesla will get us back down to 400, basically.
Yeah.
Right? So normally you kind of want to target something. It's sensible to target something in that implied move type area, right? Because the market's kind of telling you what it thinks is going to happen, right? Now, that doesn't mean that will always happen, but it's a good kind of starting point for okay, if we get a down move, well, we probably get about a 7% down move. Okay, maybe it overshoots, maybe not, right? So if you thought we were going down to 400, what is the 400 put expiring this week?
410 to 415, sir.
Okay, so now the problem with that is you buy that and we go to 400, you make no money, right?
Correct.
So, right, and you're spending $4 for it. So,
and that's what these retail guys in the US are doing. They're just writing off premium, aren't they? Because they don't understand that the vol is already priced in for a reasonably big move.
yeah, I mean, look, the point is, if it knee jerks lower to 400, you might have a small window of opportunity to slam it out the door and make some money out of it, right?
Yeah.
But look at the vol on it; it's 91.
Yeah.
Right? Where's it going? Probably 40. Right? That's a 50 vol point drop that you're going to face, even if you're right, basically, right?
And that's the crush.
Yeah. So there's ways to structure options trades that don't kill you on that vol crush and express a bearish view.
Okay.
So there's two key ways to do it, right? So if you wanted to stick with the view just being this Friday, by this Friday, you could do what we call a put butterfly.
Ooh.
Right? Where you buy one put, you sell two puts, and you buy another put behind it, right? So it's a three-legged structure. So let's say your target was 400. That's actually the option you're going to sell two of. Sell two of those puts.
Right, let me just clear that then. Clear selling two 400s.
Yeah.
Quantity 2, yep.
Yeah, and then we're going to buy something in front of it. So we're going to buy the 420.
Buying one of the 420. Okay, boom. Let me just try and so quantity down. Yep, cool.
And then buy something behind it. So we're buying one of the 420s, selling two of the 400s. Now, if you want to do a symmetrical fly, you'd buy the 380. The only problem with buying the symmetrical fly is if the thing just gaps down hard, you'll make no money.
Yeah.
Right? Which is annoying, right? So you don't really want to do that. So maybe let's buy the 385, right?
Got you.
And then what's the cost of that?
284. So the whole thing as a total cost $3.
$3, there you go.
For $20 of it.
So now if we smash through, the thing's worth $5, so you still make $2, right? Which is about 60% profit on your premium, right? And if the thing goes to the sweet spot, $20, right? For a $3 spend, you make 17 profit, which is nearly 6 times your money, right? Now, the beauty of this is when the vol gets slammed, you lose nothing off the vol, right? Yeah.
Because you're benefiting from that. Being
Yeah,
short
because
at 400.
you're long that close to the money and you're short vol on this trade basically. So you actually want a move down and you want the vol to get crushed. That's where you'll actually make your money, and you probably make 200-300% return on premium if we head into your sweet spot.
Let's go bigger. Let's say that the expected move is incorrect and it's underestimating it, and Tesla's numbers are going to be terrible. What play could we have for a Tesla down 18%, but then it does what it always does and it bottoms there and then maybe starts to kind of just slowly go back up towards...
But the down 18, does that happen while the market's open?
Yes.
Yeah, then you just go for a straight put or put spread. Because like that $4 put, if we go down 18%, where does the stock go? Where does that take the stock?
So it's 70, it's about 360, is it?
Okay, so that's still a 10-to-1 payout on a $4 put, right? If you buy the $4 put, it goes $40 in the money. That's 10-to-1.
Yeah.
So that's the thing. If you think if you've got a strong view that the implied move is wrong, and the implied move is too low, then buying options is okay, right? But if you're wrong on that view, you're going to lose all your premium.
Yeah.
Right. So you really need to have very high conviction for that sort of trade, right? Whereas my trade is more of a, I think Tesla's going to go lower.
Yeah.
The market's telling me it should go down to about 400 if it's a miss, and the vol's expensive. So why don't I give myself a cheeky free option on 6-to-1 if it goes there, right? So it's a lower conviction trade, but it could do very well, right? And it will only lose me $3 if I'm wrong.
Yeah.
Right?
Netflix, very different story in good old Netflix. But let's just have a quick check there.
Yeah, I haven't really looked at the chart for a while. Where's the stock right now?
So 12:05. It was our chart of the day today. We have a chart of the day, Imran,
All right.
which you'll have to start playing along and see if we can get your wisdom on spotting the charts. But so here we go. So there's your Netflix over the past sort of 12 to 18 months. Very steady recently.
Yeah.
Just got The Diplomat Series 3 out. I watched a couple of episodes of those over the weekend. So...
I mean, that looks like a classic pullback in a really strong uptrend, ready to go again, right?
Okay.
I'd say just from looking at that chart. I mean, we could have one more down leg to that 1100 area to complete the correction, but in an uptrend that's so kind of consistent like that, and you see those pullbacks are just these ABC type corrections, and we've done an A, maybe we've done a B, and maybe this is the C, but it needs a final little thrust lower.
Right.
So if we get the thrust lower before earnings, then you'd want to be buying before earnings.
Yeah.
But if it's kind of still here, then maybe you just kind of let earnings play out and hope that earnings is a downtick and use that downtick to buy it, right? That's what I'm just saying. Look at purely at the chart.
It does look like you could quite easily, sort of see it around those highs, doesn't it?
And you could see, how we talked about a put fly to play a down move in Tesla. You could probably set up a call fly to target the highs on Netflix, and you'd get similar sort of risk reward.
Yeah. Nice. Excellent. Imran, thank you very much for coming in. Off to Miami soon, I hear.
Yeah, you're going to go meet some of my US members, actually.
Right.
Yeah, so that'll be fun. We have a lot of people in the US because options is a big thing, retail options traders in the US.
It's huge, isn't it? Yeah, it just never really took off in the UK, has it?
That's what me and you have to change, Rich.
We're trying. Awesome, mate. Thanks very much for coming in. We got the trade of the week coming up with Chris Beecham after this. Oh, sorry. Do we have one question there? I know that's for technically speaking. Got you. Right. Good stuff. Cheers. Thanks, guys.
Cheers.
Do you like the sound of tax-free trading? Well, that's exactly what spread betting enables you to do. This tax-free way of trading lets you speculate on the price of over 17,000 financial instruments, like shares, indices, forex, and commodities, without actually owning them. With spread betting, you can benefit from both rising and falling prices, letting you find the perfect opportunity. So if you think the market's going up, you buy. If you think it's going down, then you can sell short. Not only is spread betting exempt from capital gains tax, but it's also commission-free. All you pay is the spread. With us, you're not alone. You're part of a wide community of traders that you can learn from. We've got the experts, the tools, and extensive educational resources to help you on your journey. If you're not quite ready to trade with real money, you can always give it a go on a demo account. Open an account today, join the conversation, and be inspired to make moves. Welcome to the Art of Investing, a brand new podcast to help you achieve your investing goals. Join me, Rich McDonald, and my co-hosts Mark Spice Holden and Chris CJ Fellingham every Friday when we bring you updates from the markets and insights from our combined 100 years of investing experience. If you're looking for flexible ways to trade financial markets, whether you're experienced or new to trading, you've come to the right place. CFDs let you speculate on the price of financial instruments like shares, indices, forex, and commodities without actually owning them. You can benefit from both rising and falling prices across 17,000 markets, letting you find the perfect opportunity. So if you think the market's going up, you buy. If you think it's going to go down, you sell. When trading CFDs, you're trading on leverage. Now, leverage lets you trade bigger positions with less money up front. So this increases your profits on your trades, but also remember your losses are also amplified. So be sure to manage your risk. With us, you're not alone. You're part of a wide community of traders that you can learn from. We've got the experts, the tools, and extensive educational resources to help you on your journey. If you're not quite ready to trade CFDs with real money, you can always give it a go on a demo account. Open an account today, join the conversation, and be inspired to make moves.
Hello and welcome to Trade of the Week for the week beginning Monday the 20th of October. So I had to check what the date was there for a second. It's me, Chris Beecham. Axel is off in Japan, having a nice, well-deserved break this week. So you get me instead. So yeah, we're going to go short Japan because the Nikkei's just crossed to a new record high at 49,000. Those two events may or may not be connected. But before we go on to this week's trade, let's go back to last week. Short natural gas from Axel, and it always pains me to do this, but he didn't quite work out. He had his stop at 35.70, I think it was. And as you can see, natural gas, there's that gap higher this morning. He had the rebound on Friday as Well, I think a lot of the sort of panic around markets really began to ease. You had a week of panic, really, which was very interesting in terms of sentiment. And then natural gas, sharp recovery on Friday, and indeed has just gone completely mad in opening trade. I think it's probably the technical term for it. This morning up 5% for natural gas and showing no sign of slowing down either. So that puts us back on course to target these early October highs at 3,800. Crucially, that also puts us above that July high at 3,650. And for fans of higher highs and higher lows, that's what you've got forming here off the back of that, if this one continues, as it certainly looks like you've got a higher low in place here after the one in late September. So that one, not a great one, it has to be said, but that is the point of trading. They don't always work out. So let's move on to this one for Trade of the Week, for the week beginning, I say Monday, the 20th of October. We're going to go, here we are, the DAX. Suggestions that I was going to do short Whitbread are wide of the mark, I'm afraid. Let's look at the DAX, because this is an interesting one. Big recovery here since those September lows around 23,400. How's that for an area of support? If we could draw a little bit of a box around that one. Let's get, where's the rectangle? There it is. Here's your support zone from August and September, dipping into 23,400 and then rallying. You had a big drop, of course, excuse me, over the past week or so. Took us from above 24,600. In fact, is that not quite a record high for the DAX? I think we just did nudge out a record high for the index earlier in October, and then back down again, quite a nasty jump. But it really found the lows on Friday. You can see that long candle there, right the way down to 23,600, a stabilization on Sunday, and then it started to move higher today. So that could be the interesting moment. So we are looking at going long the DAX. This one currently trading at 24,087 with an initial target. We'll assume that we'll see a continuation of this bounce because we're in Q4. Tends to be very strong in terms of seasonality for the DAX. Everyone's favourite topic at the moment. So that puts us on course back to those October highs. The question of the stop has to be said. If we go all the way down to below Friday, so that may well be a bit wide. It has to be said. I think it would be a fair thing to say we've put our stop perhaps around 23,850, which is in the middle of that candle. It might offend some of the purists out there. Axel's hopefully not watching, but I would argue that if you see a reversal back to that level, it arguably invalidates that trade. So if the price does go back down again, be prepared, of course, that we might get some volatility around this. That's why we're running a fairly wide stop. If we say 23,850, I think that's probably the best thing to look for. Hopefully the guys keep taking a note of that for when I forget. But we're looking to go long the DAX for this week, for Monday the 20th of October, with an initial target around 24,600 and our stop at 23,850. So that's trade of the week. Let's move on now to technically speaking. Don't forget, of course, put your requests in the chat for any particular ones you want to cover. One's got in early, Gavin got in early with VRTX, not one I'm familiar with. Vertex Pharmaceuticals. A good question here. Could you take a look at VRTX, and does the gap up to the 45 level still apply, or has it been in the range too long? I don't think gaps have a time frame on them. I think I understand your point, because sometimes it's sort of slightly invalidated by if you're waiting around forever and ever for a gap. But the key with gaps is they were important before, they can always be important again. Obviously, it doesn't make much sense to go too far back in time. But this one particularly, the gap was only between the 4th of August and the 5th of August. I guess that was a profit warning or something. I'm not familiar with the RNS statement on that one, or indeed the notice. So there's your nasty drop down there. We are beginning to get back to this. Interesting, of course, that's your support level from the 14th of May. The low on that one, $41.60, call it $41.70. So there's your support. If you can close back above that, which we actually did on the 8th of October, but couldn't sustain it, notably, but maybe this time around to the charm. If it can do that, that's kind of your first step on the way to closing the gap that goes from there. But it is still one definitely worth watching. And I suppose you have to argue that this rally is still suspect while it remains below that gap down level. So one to watch there, definitely Vertex. Decent recovery. It's interesting, of course, here how it found the low just about a week or so after it really slumped. So there you can see the buyers and sellers doing their work in real time. finally found the low and has started to recover. The fact you've got a slightly higher low there in late September, probably an encouraging sign. So the first step, as I say, get back above that 8 October high, and then we'll see whether it can really go on to close that gap. Could be a bit of a job to do, because as we know, markets always fall much faster than they rise. So one to watch in the short term. Might not be, might be a bit of a of a long-term project on that one. Good. Let's go on to a question from London Guide. We're going to thoughts on Glencore. Let me see if we can. Where's my mouse gone? I'm not used to 2 screens. Sorry. There we go. There we go. Glencore miners, of course, not a bad start to the day for Glencore. Let's go on and zooming this one out. Decent recovery in progress all the way through. No problem, Gavin. Always good to cover these requests, however esoteric they are. As you can see there, we found, again, this is the great example of stocks that take time to recover. Here was your longer-term downtrend in Glencore, very long-term downtrend in Glencore, nasty performance since the highs of 2023. It's been a tough period for miners, but they seem to have found their mojo over the last couple of weeks, or indeed since the April low, has to be said. But here's your push to your initial higher, just about a higher high, probably falls in that category in July. Nice little pullback, finally finds support, of course, more than once. So the August low, and then we almost retested it in early September. And then you've got the confirmation and the breakout to the upside. So another higher high here. I love it when it does this, because it's really interesting. If you look at this level here, that price level, now that's come into play, slap bang on that September 2024 low. And also close to the 2024 low from February. That's great stuff. That's always what we talk about in charting. The levels that were important before can be important again. In fact, as well, if you, this is good fun actually for charting. Your move in February when it dropped down, then it tried to recover, couldn't go back above 362. So that is your level to watch, really. At the moment, that is still resistance, and understandably, it's not surprising that the price, after such a strong bounce in September and into October, stumbled at that level for whatever reason. The charters will simply say that is the important level to watch. So until we break back above that, that's your line in the sand, if you like. It would be a healthy sign for this rally from the April lows if you can close above that. The moment is perhaps not surprising that we're seeing it pull back again. Where does it stop? We don't know. But the key thing is that it is still in an uptrend from those April lows, and it seems to have brought this downtrend to an end over the last, the downtrend that's been going on at least since May of 2024 and indeed earlier. So a bit of a reversal here. One to watch, waiting to see if there's a higher low being established, probably somewhere in this area, perhaps around 320, one to keep an eye on, and then it might gird itself up for another attempt to clear this level. But certainly, and unsurprisingly, it couldn't do it on the first bounce. If it had done that and then broken through it, that would be very impressive. But perhaps if you're watching this, definitely want to keep an eye on as it maybe has a continued pullback in the short term. A look at the triple E. Another one we're going to have a look at. Empire Metals. Well, there we go. This is interesting one, of course. I think it had a good set of news come through last week, I think, from people I know that have been following this stock, and that took us back up here. Well, the problem with these smaller cap names is that they're very much a news flow liquidity element, because it can we see quite volatile moves. But there's your nasty, it's opened higher, couldn't sustain it, unsurprisingly, coming back through again, right back down towards 50, and has continued to drop. I apologise for my coughing. 30p, the low from the 16th of September, the one to keep an eye on. Certainly looks in the mood to do that. Now, it is at the moment, today, and of course it's not closed yet, but it is finding a little bit of early support around the 100-day moving average. That may just be coincidence, has to be said. Often you see prices do find support around moving averages, but it's one to work, to keep an eye on, rather than to hang your hat on. Otherwise, you're really looking at this 16th of September low at 30p. That also coincides reasonably well, and not as elegantly perhaps as we'd like it to. Just this area around 30 pence, 30 pence and a half, as it is. Trying to do that in my head is not great. That was your high from the 24th of June. Maybe where the buyers finally step in again. Empire Metals, it's been a hell of a run on this one. consolidation after it getting a bit mad over the past 2 or 3 months, and then it's come right back down again. But there's your line in the sand at the moment, probably. If it can hold 30, then we'll see what it does. If it closes below 30, might be a lookout below moment in the short to medium term, and then you're looking on down towards, I suppose, the 29th of July at 24p, and then below that, the 27th of June, coming on at about 22.95 pence a share. So there we go, Empire Metals. Company that annoys me if you're going to have a small M. I don't know if it's just us or whether it's how they do it themselves. Hims and Hers, they were down on Friday. They were up or down on Friday? I can't remember. Down on Friday. There you go. This one keeps cropping up, and it's not one that we've covered massively. Now, there, of course, is your line in the sand on the upside, isn't it? Every time it gets up to this level, it doesn't want to hold on, and it drops back again. As you can see, though, the big support on the downside comes through from these June and August lows around $40. After the size of the drop over the last 2 days on Thursday and Friday, some sign of buying coming through at the $50 mark. So that maybe there's a hope that we get a higher low established here. Perhaps watching for stochastic crossover that might go here, because that was a positive sign the last time around in August. It is essentially a big range trade. Maybe this is now developing a slightly higher low here, which would be a positive sign. And then we're seeing really whether it's got the strength to bounce back towards $67, $68, and then will be really the litmus test. Can it get on through this level? So if you're obviously looking to, thinking about this as a potential trade, you would simply say, well, I'm looking to buy it, for example, here. If you wanted to wait, maybe to move slightly higher in the shorter term, but if you want to do it, buy it here, you'd probably say put your stop below these recent lows. Give it, again, as I always say, some room to breathe. There was support earlier in July around sort of 47.75, so you put it down there. Gives you some protection against volatility, and then you've got reasonable sort of risk to reward of a stop here, but then a target but moving back up in this direction of $67. So that's Hims and Hers. Keeps cropping up, really. It's a very popular name. I'll do more work on them next time. B&M, of course, this morning's shocker. In fact, slightly lower than when we talked about it earlier. If it opened sharply lower, bounced, and then the sellers have come back in again, talking about beating somebody when they're down. This is definitely where you get it with B&M. This is a record low. I think we checked this in the open. It's the lowest level for the stock ever. So we're kind of in uncharted territory, and not in a good way, in the same way that gold is in uncharted territory, because we're at lowest levels. We've never seen this before. We don't really have much in terms of to work with, really. Because I think if you go back to the one, what was the one we covered? Was it Vertex? Yeah, if we looked at this one as your previous example of a nasty gap down profit warning, I guess that's what it was. It took about a week for it to settle and then find a low. It is possible that the same thing happens here. I think you had the initial slump, you had the initial bounce following that, and then it's going down. It's now down 17% as we're talking. So at the moment, unless you're doing this for a sort of a long-term fundamentals-based trade, and you're simply saying, I think it's worth it now on the valuation of whatever it was, 5.6 times earnings and an 8% yield. At the moment, the price action isn't giving you a level to buy. I think the good buy on a technical basis isn't there yet, because we simply don't know. It might have a terrible session today. It might drop another 10%, because it feels like that kind of market where people are being very, certainly not happy with it, to put it mildly. Obviously, if you get a profit warning, kind of not dressed up as such. It was a guidance on profits rather than saying, oh dear, everything's gone wrong. The 7 million of costs they've discovered somehow translates into a 40 million pound hit operating profit. I'll leave the accountants to tell you how that one works out. Obviously, the shares have not liked it. Even worse by the fact that the CFO has left, which raises the risk that once you start digging around, as we said earlier, once you start looking for this stuff, it gets worse. Sorry, this is technically speaking, but we've got to do this because this is a fundamental-driven story. We don't know, essentially. Unfortunately, that's not the answer you probably want to hear. If it starts to bounce, if it can recover... See, we don't even know, because this candle, obviously, we're still very much we've got hours left in the trading session. But for example, if it can get back above £2 a share, maybe that's a slightly positive sign. Markets love a good round number. If you can get a close back above this low from the 7th of October, maybe there's a sign there. But of course this is going to be anything at the moment is a counter trend bounce and is therefore suspect until proven otherwise, because you've had so many false dawns here back in 2024. Look at this one from April. We thought it finally bottomed. The answer was a resounding no. Steady recovery and then down again. As interesting, channeling my inner Axel Rudolph, here's your negative divergence on the stochastics here, because you had a lower high from stochastics just about, but a higher high in the price. So there was your signal, if only we had but known at the time, that the price was due for another beating. And the fact it's closed below these lows from early August just means we are in a wait and see moment. The price may give us a firmer indication. If you get 2 or 3 days of gains above these lows, then you've got a low you can trade against. And say if it drops back below that low from Monday, then we know that the long trade is invalidated. That would be how I'd look at it at the moment. So Blake 7, great name, by the way. It isn't. I think at this point, we're just in a wait and see. Watch it over the next few days, see how this poor beaten down stock gets covered, or whether it's just clobbered even more, I think, at the moment. And then finally, finally, it is finally, but FTSE, we should talk about an index. It's just like charting the markets again. I must try not to go back into old habits. See, this is nice. I like this in terms of a trend. Really, really smooth. It's been above the 50-day moving average for weeks and weeks and weeks and weeks and weeks. And then we get through to September. This is where it's interesting, because it's finding support around this 50-day moving average, if you want to put it that way, or around the 9,200 level. Dips below 9,200 found buyers during the course of the middle of September into the second half, which gave you the foundation for the next bounce. And again here, after what essentially was a sideways week, it dropped sharply on the Friday the 10th, and then it spent the week trying to rally, bounce back down again. But again, the buyers came in at 9,300. Here's your sign of a low. And this is what I mean. There's your low being formed. You could say, oh, you could buy it here. You could put your stop like we did with the DAX about 92.70. If you might think it's a bit wide, you could certainly say that 93.40 or so is your real area of interest, your line in the sand, if you like, because that was the mid-August high. We also tested it in early to mid-September, if I can put it that way, 12th of September, and we dropped back again. We finally pushed on above it to new highs, new record highs, in fact. And what happens when we get here? Well, the selling stops on the 10th in this zone, and then on Friday, when it was getting a bit messy, the buyers came back in and it dropped below that level. So there was your sign that it could be that a higher low has formed again. You've not got a stochastic crossover, but certainly the price action is already moving in that direction. So it could be that once again, the uptrend has reasserted itself. And then also SWC. Gosh, you really like me to do these ones, don't you? Always such a contingent. No, it's smart. Oh, it's on ISA. Can I get it on here? We might. I thought I could. Okay. Oh, CFD. All right, let me just switch over then to my less used CFD account, if you can bear with me a second. Most kind of you. No, I know. Oh, it's just not working. I can't do this one. SWC. Isn't live TV fun? No, I've not got an ISA on this one. I'm just old-fashioned. Sorry about that one. SWC, Steve, I apologize on that one. I can't do SWC. I will get an ISA level sorted out for that one. Good. Any other requests before I... No, I think we're done. Thank you very much, everybody. Thank you for joining us for the week and technically speaking. Axel's away for another week, so you get me next week again. Don't forget to like and subscribe, and see you all again on Wednesday for Charting Crypto.
What a day, what a day. This is Overtime. I'm Ilya Spivak here in San Francisco. That's Dylan Radigan in Milan, Thomas Westwater in Chicago, and whoa, we got a conversation for you today. I don't even know what we're going to say, but looking at this price action, we're going to say something fiery, no doubt. Cuckoo birding and all. Gentlemen, how goes it?
It's going. Yeah. It's quite a day. I mean, across a few things, not only the equities, but the metals, you know, all of it.
It's a spicy kind of day. And it's a spicy kind of day for all kinds of reasons. It isn't just that we have a down day in stocks, and we can go right to the charts here. I just wanted to point out for you gentlemen the framework that we've been talking about here all week. This idea that, okay, so we had this massive sell-off ostensibly on trade war Michigas on Friday. And since then, the order of the day has been, give me a rally and I'll sell it. Because all of these attempts to try to recover, to try to buy this dip, they've all failed, one after the other. We get another big one today. So the most interesting thing about this price action seems to be that the trade war story hasn't gotten any worse, hasn't gotten any better necessarily, but all of the conversation out of Besant and Jameson Greer, the USTR, and all these other administration people has been an effort to calm things down and say, listen, it's not that serious. Nobody's going to go there and torch these talks between the U.S. and China. And the president himself even came out and tried to smooth things over. But we can't seem to get any momentum on a rebound, and the NASDAQ, of all things, is underperforming. Do you guys think that this is a trade war story at all?
I mean, I tend to think, I think today was the most interesting day yet, I think, for obvious reasons. And I, you know, I think that what happened today very much validates what you have been asserting from the get-go, going back to last Friday, which is that the market is behaving this way because the levels are on a price extreme. It's overextended. There's lots of air pockets underneath this thing, and provoking it with anything is capable of incredible velocity to the downside.
Yeah.
And I agree with basically with everything that you just said, which is that, one, it feels like the ethos or the hypothesis of the market has flipped from, you know, buy the dip, at least for the moment, to absent a real reason to go higher, I'm going to sell it.
It seems like that's becoming a thing.
I need a big AI headline. I need a big Fed headline. I need it. Like now it feels like it's the other way around, where it's like, listen, all else equal, sell it. As opposed to before last Friday, it really felt like, certainly for the last few months, all else equal, buy it.
Yeah.
And the only reason I can even begin to offer an explanation for that or to that or about that is it's a referendum on the price levels, which are on extremes. It may, you know, if Vecchio was here, I bet you he'd say it's a referendum on seasonality.
Maybe.
And, you know, our friend Andrew Ross Sorkin has got the crash book hot on the front page of everybody's iPhone these days. So 'tis the season.
Indeed.
I mean, it's an interesting moment. It's an interesting moment to take a mad dog put position, or at least sells maybe some call spreads on the NASDAQ and take advantage of the expanded volatility. So the more conservative maneuver, I would say, that I'm personally entertaining is NASDAQ call spreads. And then, you know, the wild one.
Selling them, you mean?
Selling them, yeah. And then the wild one would be just to straight up buy puts, or at least put spreads, to try to mitigate the vol expansion well out of the money. You know, I mean, I think that there's a higher chance than there has been that in the next 3 weeks, let's say, the next 3 to 4 weeks, even the next 2 weeks, that there's a barn burner of a sell-off. that makes Friday look like a warm-up act, which is not a prediction. I'm just saying that the pot odds of something wild happening seem to have gone up. And I actually look at today's market action as much more concerning than what happened on last Friday.
I would agree. There's an interesting caveat here, but before I go there, Thomas,
or for that matter, Tuesday. Sorry,
I agree. And there's a caveat here today that I'll delve into, but Thomas, share your thoughts here first. What is this telling you both about today and about kind of the landscape?
Well, today there's something that not too many people are talking about yet. It's on some headlines, but go to KRE.
Yeah. There was a kerfuffle today.
Yeah, there's a couple regional banks that made a bad
Zions,
loan.
I think, and one other one.
Yeah, two that made the same loan to a smaller bank that it went bad. I think it's something to do with fraud, something like that. But it's a pretty large loan. I think 150 million. But this is one of a few other bad loans or loans that have went bad over the past few months for regional banks, and it's starting to paint a story of I don't know if it's subprime lending, but lending that slightly riskier lending that sometimes regional banks do. And this also dragged XLF down a lot. I think XLF was one of the worst sector performers in the S&P 500 today. So it seems like the story now is just to sell these banks, get them off your books, and reassess the situation. Does that speak to something like more trouble in the economy amid these banks that are doing a bigger portion of their lending to consumers or to small businesses? So this is kind of adding to the fear narrative of an economic decline or some kind of prelude to it. So that I think hurt a lot more than just it being sector rotation or selling the rip. But it's interesting because it was a risk-off atmosphere today. I mean, gold and silver told that equities down. So there's we're swinging back between buying and selling. It's FOMO buyers trying to come in just to buy the dip because buying the dip has been something that has worked in the past recently. But you never know if this time there has to be a time where you're going to get an extension to the downside. So what I've done is I've lined up my portfolio a lot, even though I wasn't exposed to too many equities before. But I've really taken down my amount of capital that's allocated to trades. And I think we might need to, I mean, tomorrow's Friday, it's before the weekend. I'm not too optimistic that, maybe we get a small bounce again tomorrow and then it sells off in the afternoon session going into the weekend just because people want to de-risk. What is Trump going to tweet over the weekend that you're not going to be able to get in and out of your trade? So I'm going to wait till Monday until I put some risk back on. I took one shot just to get some exposure in AMD. I sold a put spread. That's pretty much all I did today. I tried to get that iron condor back in oil, wouldn't fill again. So that's the second day it hasn't filled. I don't know why, but yeah.
It's an interesting setup. I'm glad you pointed this out. In fact, this is a chart from Zero Hedge. Every now and again, we do look at Zero Hedge. Every now and again, they do have that right story that no one's talking about. And this is Zions Bank Corp and Western Alliance. To your point, Zions Bank Corp fell after a $50 million charge-off for a loan to a wholly owned subsidiary, California Bank and Trust in San Diego. And Western Alliance Bank Corp took a dirt nap also. They apparently are saying that some borrower of theirs, quote, failed to provide collateral loans in first position, which is basically a fraud allegation. So not great. And very much a part of this story. The other part of this story that's very interesting was the Fed speak part, because that too has a role to play here, and you can see it when you look at these Fed rate cut odds and the way that they've developed. So first, let's take a look at October. And obviously, we're still very much in the high 90s here for a 25 basis point rate cut. But look at this little guy right here. This is now the probability of a 50 basis point cut later this month, which is now up to 5.3%. So you take that 5.3 together with the 94.7 here, and uncertainty about this rate cut is off the table. It's 100% likelihood that we're going to get a cut this month. It's a given now. And what's interesting is that we got out to maybe a 50 basis point cut. But hang on, there's more. Here's December. So for December, we're still looking 81% chance that we'll get another cut. So the third of the year, the second after September's. But look at this. We're looking at an 18% probability now that either October or December give us a 50 basis point cut, and a minor, less than 1% chance that we're going to get 50 basis point cuts at each one of these meetings. And that's obviously unlikely. But nevertheless, the market went into a really dovish kind of space today. And when you look at sort of where all of this comes from, what all of this does to Fed policy expectations, not just for this year, obviously, but also for especially next year, because that we're going to have three cuts this year has been a given for a while, where there's 25 basis point one at each meeting after September. So September, October, December. That was in the Fed's summary of economic projections. The market's already had it mostly benchmarked. That's not controversial. What's controversial is what we now see as meaningful possibility that it's not going to be 75 basis points in total. It's going to be 100. That is to say, one of these next ones is going to be a 50 basis point move. But also, next year is going to be more dovish than we previously thought. Here's the SR3Z6 contract. So this is the price on interest rate futures for December of next year. And you can see here, massive move higher in the price, which is the same thing as a move lower in the yield. And so this is more rate cuts. Now, how fascinating is this after months and months and months of listening to anything dovish being a risk on, buy them if you can do it kind of a situation. The market has loved anything that smells like rate cuts basically since the middle of the year. Once the kind of nonsense after April's Liberation Day and the foam board kind of settled, markets took a few weeks to kind of digest all of that. They bottomed, they figured things out. And since then, anything dovish, buy the stocks, baby. Risk on. This is the polar opposite.
Is there a certain time that this spiked higher, or was this just gradual throughout the day?
As a matter of fact, and I am very happy to point out that where this happened, here's a 15-minute chart right here. You can see it right there. And what's interesting about this is about 9:15 in the morning here Pacific time. Let's take a look at when the S&P 500 took its nosedive. Oh, it's right there. This is where we actually cleared the range, right? So up to here, you can say, we're range bound, we're coming into the bottom of the range. Boom, 915. We break right here. It's the same thing if you look at NASDAQ, of course. No big shock. Right there. There's the breakdown. This is essentially the dividing line between pullback and a breakdown, and that's a breakdown. What's even more interesting about this is that if you look at what the dollar was doing, here is that same time frame right here. And again, here's the low. So the dollar comes back to the low, it's testing the low, it breaks right there. So all of this starts getting really, really interesting. Here's the euro, just to make it official here. Oh, and by the way, before we do the euro, here's the Aussie. Aussie right here. So that's your risk-off response. Again, that's the move that ultimately takes these ranges out. And here's the euro. Boom. Right there. So what's interesting about all of this is after months and months and months of saying la-di-da rate cuts, what we get here is a weaker dollar, weaker stocks, stronger bonds kind of a response. Now, obviously, one would go and say, well, what happened there? And there, as it happens, there's an answer. What happened there was maybe next Fed Governor Chris Waller came out and said a bunch of dovish things. And although Kevin Hassett looks like he's favored by the betting markets here to be Trump's nominee for Fed chair, it seems like that's the path of least resistance for now. Both Kalshi and Polymarket have him ahead. Waller obviously is somebody who is a top 3 contender here. And so since he is, the markets were paying attention, and he said a bunch of dovish things. So here we have an interesting situation. The markets are taking a catalyst that before was a risk-on catalyst and making it into a risk-off catalyst. If ever there was evidence of regime change, this is it.
Regime change where?
If the previous regime was dips are bought by the dip,
And rally, and now you're saying that
the current regime is sell the rip.
Sell the rally.
Yeah.
I mean, I don't disagree with your overall assessment. I am a little skeptical of any. I mean, this euro chart is not exactly a compelling.
I'm very skeptical of any lasting dollar weakness. I don't think that holds.
I mean, how much is this dollar weakness? I mean, it looks to me like an unchanged chart over the last week.
I would agree.
I mean, come on.
I would agree. The part of this story, and obviously, as ever, I'm talking my book, but why wouldn't I? That's why I have it on. If you look at sort of what has happened with the dollar here today, what there is seemingly is a correction. But we're still in the same range that we've been in. We haven't gone anywhere. And if anything, this is still a dollar that refuses to fall.
What did gold do today?
Looking at, gold did what gold does, which is that. And when you consider that apparently the catalyst was something dovish from an important Fed speaker, this makes sense. and you get sort of this all-weather thing from gold, as we've been talking about. Here's the daily chart on gold. So this is what it did just today. And it's this thing that we were talking about, Dylan, with Mike Butler yesterday. This idea that gold has become this kind of all-weather thing where it's like, well, I don't like the risk environment, and this is one thing I can own where, were I to be worried about the risk environment and the dollar and this and that, this sort of answers all of my concerns.
I mean, whatever it is, though, I mean, I don't disagree with any of that stuff. What I find alarming / impressive / perplexing / concerning is that you're looking at what amounts to a 25% change in valuation in the last 6 weeks.
Yeah. Yeah.
In a massive asset class.
Yeah.
And it basically straight up, with the exception, I guess, of that one meaningful down day.
Yeah. There's a little wiggle here.
There's
on
one
October 9th.
moment.
Yeah.
I mean, the crazy thing is, because again, it's antithetical to my don't think and buy the Mag 7 routine. Like, I'm so tempted to short this, and at the same time, I'm so glad I haven't.
Yeah. I mean, it sort of goes back to what we said yesterday. And Thomas, I'd love your thoughts on this gold chart and what there is to do with it. I mean, obviously the don't think argument is the thing's going up, buy it. Don't worry about that it's expensive. Just buy it.
Up goes up.
I'm still of the mind that I don't want to re-enter it. I mean, obviously I've been long most of this year, but I don't want to re-enter it here. It feels crazy and frothy, and I would short it, but I need a downtick. I need something that looks like a price action signal of a top. I'm happy I didn't jump in short yesterday, because I would be annoyed by what's going on today. So what do you do here? Anything?
I mean, this is one that's, it is tempting to short, but you could also said that a few days ago, and yeah,
exactly.
You could say that any time in the last month and a half, and you would have been
right,
unpleasantly treated.
I got out of my long gold last Friday because I thought, all right, it's made its move. I have a good profit on the trade. I was thinking about rolling, but my thought is like, it's run pretty far. It's due for a correction, but that kind of thinking is really, this example is how that kind of thinking is. You're fighting what the market is giving you, and
you're trying to be smarter than the market, which is typically a doomed proposition.
Right.
Yeah.
Right. And on the other hand, it's also tempting to get long it now, because you look at, like you said, the past month and a half, but it's also scary to get long at this point, because at some point it's going to come due that, you do have a correction, and it's going to be driven by profit taking. It's probably not going to be driven by a change in whatever's been driving the price higher for the past 2 months, because that's been, a lot of this buying is done on a longer term thesis of people that buy and hold gold, and it's done on these fiscal deficits are rising, not only in the United States but in Europe, because
everywhere.
They have to bolster defense spending because of this whole Ukraine Russia thing. It's been driven by central banks buying, because while the official data shows that central banks aren't buying that much, it's hard to track all of that, because the World Gold Council is pretty much the only one that gives out that information, because it's very hard to track all of these physical flows and everything, because there's not centralized exchanges and marketplaces that track all of this and publish the data. So they outsource, the World Gold Council outsources to a firm. I forgot what it's called, Metals Focus or something. And they put out data that is based on unofficial data pretty much. So what they are doing is putting out a number that is essentially an estimate. It's not official data, like a central bank reports their balance sheets or anything. Some of it is based on that, but it's really, you have to take them at their word for it. And what it shows is central banks, this is the unofficial data, is that they're buying aggressively this year. And I mean, we've seen that in the first half of the year with the PBOC. They were buying. They're still buying, but it's a slower pace now. But it makes sense, right? All these, after this trade war, after Trump got in, all of these countries want to diversify their balance sheets away from the US dollar. There's only so many assets that you can do that with, given the amount of capital that, you have to allocate out. So, gold is one of the natural places. It also appears that silver is another. And I mean, that's what we're seeing in both. So shorts are getting squeezed. The cost to hold shorts is going even higher. So you're less incentivized. Even at these high levels, you have to pay more to get into that short position. So it's really, you have to take a really big risk position to get short these metals right now. And we've seen that in silver. For instance, the London already had a reduced supply because for some reason the past couple of months, India has been buying a lot from London instead of Shanghai and other places. And that has driven up the cost to borrow in London. It's opened up, a wider spread where London prices are up here and, the US price is lower. So what people are doing is buying silver in the US, physical, and moving it to London. And that's creating, this arbitrage window. Those always close because the arbitrageurs do what they do, and that eventually closes to where it's not profitable anymore once you factor in the cost of transport. So, I mean, silver is something I got out of earlier this week. I held it a bit longer than gold, profited pretty well on both trades. But now I'm also at the point on gold where I'm like, do I short this or do I get long? Because the IV is very high in both products to where you can set up a trade that looks really nice, risk to reward, POP, everything like that. But it's kind of just putting me in this state of paralyzation where I'm a little, it's going to keep moving one way or the other. I don't see it consolidating right here and building out a range. This is a really extended run. It either has to keep going or it has to hit a point where it really pulls back. So if you're going to short one, gold or silver, you have to consider there's less liquidity in silver. So if the rug gets pulled out here, which one is more likely to drop faster? I think that's probably silver because it's a less liquid market. Liquid enough for a retail trader. Liquid enough for a retail trader. I'm talking about big traders, so if anyone wants to get short and they're convicted in their views, I mean, silver might be the better option.
Yeah, I mean, you sort of have to look at the risk sentiment component. Also, silver tends to be a little bit more sensitive to risk. So if we think that stock markets are finally rolling over, this is going to be a more painful unwinding. And there's going to be additional downside pressure here where it wouldn't exist in gold. I want to highlight the point that you just made. Something that I've been reading very avidly here. There's a great book on U.S. economic warfare called Choke Points by Edward Fishman, who's a former administration official in the economic warfare realm. And so he had a front row seat to a lot of this stuff. And it's a very, very interesting book. And what's interesting in particular is this idea that it's not necessary, like that what this trade war does is not so much negative for the US dollar as such and for US markets and the use of the dollar in financing commerce and all of this. It's that if the US and China don't get along, and you're a third country, you have to be able to do business with both. So if ultimately the US and China diverge and have to operate on different systems and different rails for payments, for transaction clearing, all of that, then if you're Brazil, South Africa, any
Germany.
European country, then you need to be able to operate in two different economic spheres at the same time. And the way to do that would be to start to move capital into a third asset until that kind of a system is born and you sort of know where you're going. So it's not so much that people are jettisoning the dollar. We can very clearly see that they're not, as a matter of fact. Because since July, the dollar hasn't made a new low. So, and the trend is higher. So you see this rip in gold, and basically everything you've seen of this rip since about here, all of this run up in silver from July and onward, it's obviously a massive move, similar to what we see in gold. Here's gold, here's July. So all of this rip from late August onward has happened at the same time that the dollar has not weakened. And so the idea that this is some sort of a debasement thing about the dollar is just wrong. It's just wrong. Because that's not what's going on.
You're
Very
suggesting the
plainly.
metal thing is a neutral position in the unresolved trade war between
Yes.
China and the U.S.
Yes. It is capital saying,
that it's a reflection of sentiment on the intensity of the trade war.
yes. And the idea that what may happen at the end of this thing is the US and China just put up barriers and tell each other that they've divorced. And if you're a third country, you've got to be able to work in two spheres of influence separately. And to do that, you need a third asset that can move between those systems. And
you're
that
saying
asset is gold.
metals or that. What about crypto? Wouldn't that be a crypto argument as well?
Doesn't seem like it, because it doesn't seem like there is any appetite to say that crypto and gold play the same role here. I would argue the reason for that is because China seems to be, in its kind of very aggressive buying of gold, seems to be, and silver, but mostly gold, seems to be attempting to say, look, we can't back the yuan with the kind of financial depth that the US can back the dollar with. We can't back the yuan with the kind of liquid markets, sophisticated assets, deep, endless liquidity. We just don't have it like that. But what we can do is we can say, listen, all of the transactional flows that pass through our clearing, as opposed to, let's say, SWIFT or CHIPS, the US dollar rails, all of the stuff that's done on our rails will be backed by gold. The currency won't be as such, but the transactional volume, yes, it's a smaller number. And in doing that, you sort of entice people onto the system by saying, look, we know the yuan is not internationally convertible, and so people don't want to use our rails because they don't want to end up sitting there with a big bag of yuan that they can't do anything with. But here, we will commit to you that if you have a big bag of yuan as a consequence of transacting on our systems, like, for example, Russia does now, right? Russia perpetually sits with a big bag of yuan now. We will commit to give you gold for your bag of yuan, which if you really wanted, you could then go back into the dollar sphere and use. So, and Bitcoin is obviously not a thing that they've done that with. Bitcoin is not something that China is accumulating in size to say
No,
we're going to backstop our system
would
with
you go,
this.
so then would you go so far as to say, let's one assume your assertion that the precious metals rally is an indication of a measure of the heat of the sentiment on the China-U.S. trade war.
Yeah.
Let's also then assume that this is an indictment of crypto's assertion that it is a third rail in the global currency markets.
Oh, yeah.
Because look at the chart.
Yeah, I mean, this gold, this is not.
Bitcoin is behaving
clearly.
straight risk on, risk off, old school, just straight speculative risk off.
Obviously, yes. You can see it with the naked eye. This is not gold.
Nothing to do with currency, third rail, none of that jazz.
No, this is essentially, and by the way, it's worse than risk. Because if you look at this and you go, okay, what's happened here? Let's say since the last time this had a meaningful rally, right? This had a meaningful rally into a peak in basically, let's call it mid-July.
No, but I mean, I would say that April to July correlates to the dollar's crash.
Well, sort of. It more so correlates, I would say, to what stocks were doing, right? Because stocks had this same up and down. They started
the dollar went down catastrophically. The year.
Catastrophically.
At the same time,
but the dollar was already going down here.
Yeah.
And this was going down with it.
Yeah.
Because this was just risk off. This was going down with stocks. This was going up with stocks. Until we get to July, by the way, where the dollar stops falling.
Is this just a NASDAQ derivative now?
It starts to look like it, only worse, because the NASDAQ has performed better.
And the NASDAQ has enterprises that have discounted cash flow of real value. You may be overvalued, but there's a real underlying business inside the NASDAQ index.
Yeah, I mean, let's consider, right? This is July 14th. Since then, this has gone sideways or down. There was a little bit of an overshoot here, but it lasted, all of 48 hours? So we have from July 14th, hold that date in your mind, sideways or down. Now, NASDAQ, obviously, we don't need to get too cute. Here is July 14th right there. So NASDAQ over the same period of time has gone up and up and up, clearly. It's struggling the past couple days, but risk has outperformed Bitcoin. Full stop. Let's take another step here. Here's the dollar. Where's the bottom in the dollar? Oh, look. Here's July 14th right here. Coming off the bottom. The sort of dynamics we've seen in Bitcoin, sideways or down, have basically mirrored the dynamics in the dollar, sideways or up. And so it's not even risk at this point. It's just a straight up anti-dollar that isn't working because the dollar isn't falling.
And other than if you start to then that's why, listen, I think we kind of all know this. I don't know if we all know this. The thing with Bitcoin is it's always looking for the next story to rationalize its existence.
Yes.
So it's a fiat currency alternative. It's the blockchain store, vault of all data and all title transfer and all commercial transactions. It's currency bypass, whatever. The most recent version of the sort of attempt to justify its existence seems to be this Musk rhetoric in the past few days that Bitcoin is collateralized by electricity.
Hilarious.
Which just strikes me as evidence of the fact that that Bitcoin is a worthless pile of dog do.
Yeah. I mean,
you have to constantly come up with a new explanation for what its value is.
As the great Ace Ventura said, fiction can be fun, but I find the reference section much more enlightening.
I mean, if we're no longer a currency alternative and we're not a commercial transaction, interface, the digital commercial transaction interface of the future, and now suddenly the Bitcoin bulls are like, no, it's just a normal currency collateralized by energy.
I mean,
I guess what I'm getting
sounds.
at, is there a reason? Do you have are you willing to short it? Just to go.
I would say yes, because now what there is a wonderful way to do it through the ETFs. I still need a price signal. So for me,
I mean, that sell-off doesn't get you interested. I mean, what do you need?
this is it right here. So I'm looking at this here, and I go, okay, here's the range bottom. Close under it. Close under it, and it's good night. And the vehicle for me would be IBIT, which you can see is sitting on this same bottom here. Boom. And if you were to try to trade this, let's say, I don't know, let's say all the way down back to like 42, 43, right? 43, let's say, is your rough bottom on this thing, most recently. That's a long ways down. So let's say we go typical tasty methodology, in this case a little bit less than 45. Let's go 43 days out, and let's keep this very, very simple here. We're going to go long a put spread from here, let's say, to the next big pocket of liquidity looks to be at 54. You can see that here. I like to look at this volume column to make sure I get filled on things, and that also kind of tells me where the market is clustering its interest. So, I mean, max loss 175, max profit 425. That's incredible risk reward. I mean, that's excellent. And you lock that in with a probability of profit of 43%. So we were saying on the show yesterday, you need to have risk reward of 3 to 1 to be making money, being right 30% of the time. Here you have 2.4 to 1 risk reward, and chances are 43% it works. If we extend out, can go out all the way out to 50, risk reward still amazing, better than 2 to 1. And if we wanted to go all the way to that bottom that we were just talking about, it's not that liquid, still solid. I mean, lose 300 to make 1,200. Excellent. Not as liquid, so I might restrict it to somewhere here. And obviously, these are indicative volume numbers. This is this close now. So if you take out this bottom here, down to 50 would be to about here, which is a nice level to be aiming for. So I am very into this idea. I just need a price signal.
And you
even
don't,
on the 4 hour, it can't clear.
and you don't
so far.
believe Bitcoin is a store of value, right?
No.
Right.
Nope.
And I'm not sure how people are still hung up on that. I've not really seen a lot of evidence for that. So if the market sells off even more, I think Bitcoin is going to go lower. I see it more as a speculative risk type asset.
Let's be clear too. What's a store of value, right? Like a leg of lamb is a store of value until it spoils, right? So anything can be a store of some value as long as somebody is willing to give you value for it. Is Bitcoin a good store of value? No.
I mean, Thomas, I just saw the Musk now the Musk rhetoric this week that now it's that Bitcoin is a currency backed by energy is the newest like spiel. And to me, that was the biggest red flag yet. That there's this sort of rotation of efforts to create a justifying narrative, and that it changes so dramatically and so quickly, sort of makes me think this is all a bunch of BS, you know?
Yeah, and you know, if you're buying Bitcoin or if you're buying gold, and some people do buy gold as a real store of value, as in an oh shit situation happens, whereas there's a world war or economic collapse or something like that. If that happens, you're getting energy disruptions, you're getting internet outages. If you need food and you have Bitcoin, you're not going to find many neighbors or even be able to maybe use your phone to trade your Bitcoin for food. If you have gold, you can melt that down, divvy it out, and now you can pay your neighbors, pay whoever to get food, and here's my gold. You know, you can't do that in Bitcoin. And that's an extreme example, but I think that speaks to, and this is thousands and thousands of years that gold has proven that it holds its value through wars, through peacetime, through all of that.
Well, because it's a very natural kind of, to your point, like you can melt it down, you can divide it, it doesn't tarnish, it doesn't go bad at the bottom of the ocean. It's the kind of thing that's, if you needed a sort of avatar for value, it's a really durable avatar just in terms of what it is.
I tell my wife, you need the 3 G's if the world is going to collapse. You need gold, guns, and a garden.
Yes. Ladies and gentlemen, patent pending Thomas Westwater. That's fantastic.
Yeah.
Yes. Yes. I would think that, and sort of knowing what I know about my immediate ancestors coming and going amid the Russian Revolution, World War II, and sort of various calamities in the Tsarist and then Soviet sphere, of which I come, it's not even just gold, it's jewelry.
Which is
because if something is already subdivided and in kind of consumable chunks, that's the barter mechanism that works really, really well, because a gold bar, of course, is difficult to shave down.
And
so
the bulk of gold held by regular people is via jewelry. Most people don't have gold bars stored away. A lot of people do, but most people have jewelry. That's what the big portion of weight in gold held by people is via jewelry.
Yeah. Yeah. And I mean, these are firsthand accounts. I mean, grandparents and great grandparents telling stories of how they survived World War II amid a collapse in any kind of currency, and it's barter for jewelry. And then, of course, if you really are betting on the end of the world, then betting on the continuity of markets to be liquid and to fill you on things is probably not the bet to make. You have to sort of believe in if you're going to be betting on the end of the world, you probably don't want to be betting on electronic filling of orders. And so you're looking at physical things and canned food, a garden, and ammo as kind of assets of note.
I mean, I would just like to point out the market is just off of all-time highs.
Yes.
Technology is the most profoundly compelling and creative it has ever been in the history.
No question.
And I think we're much more likely to be in an era of extreme abundance.
I completely agree.
And in one where we need a gold, guns, and a garden.
I completely agree.
I'm perfectly happy to have some gold, a gun, and a garden. Nothing against it. I particularly like the garden. But the garden for me is more of a source of pleasure than it is a security infrastructure for the apocalypse.
I absolutely agree with the idea that investing with a mind on the apocalypse is probably not the way to go. It's just not a good investment thesis.
And for me, my worldview is one that is fundamentally optimistic and, abundant. I just think we're in an era of abundance, and I think that abundance is what is around us, regardless of these price levels from one day to the next. I agree that the market's a little squirrely, whatever. But I don't think that, I think that maybe not from a trading standpoint, but from an investing standpoint, this thing keeps getting kicked around a little bit. I think it's a great time to get into the AI. Buy Amazon. Get some of these stocks and just tuck them away.
So looking at what the mags have been doing here, and I agree with that idea. I mean, as we know
and
from
not
our
as a trading, from a trading perspective,
right,
I like your Bitcoin trade. We kind of went over that, but from just in terms of asset accumulation, this is a sort of cliche, but it's this old Warren Buffett thing where, stocks
become nauseatingly
when they go lower
on this idea.
Buy them when they go on sale. Like,
yeah,
what are you doing? Like, you want to buy them not when they're buy low, sell high. I can list all the cliches, but
sure.
I think that this is a kind of a moment to remind yourself of that. Now, I don't see that the decline in the Mag 7 is that great that I'm not excited about anything, relatively speaking.
NVIDIA was still up.
Yeah. I just think Amazon particularly is interesting here for all the reasons I've said.
Yeah. Sort of philosophically, I completely agree with that thinking that what we're looking for here, what I'm looking for here being bearish is not the end of civilization. I'm looking for a frothy market to have a pullback. And a sizable one, something that's maybe reminiscent of the .com sell-off, something that's maybe reminiscent of previous kind of stage one technology revolution washouts. We've seen it in railroads, we've seen it in telecoms, we've seen it in all kinds of things. The history of these things is very clear-cut. So I'm looking for that. I am not looking for civilizational collapse. So when this thing is on meaningful discount, you will not hear the end of my endless bullishness. I will be buying everything. Speaking of Amazon, kind of leaking lower a little, but not
You're
really
getting a breakdown in the Mag 7, which is kind of what you'd like to see.
Yeah, not a meaningful one. No, it's certainly not lost on me that a lot of these things start to look like the Nasdaq, where you have a kind of range and then a big wash down on Friday and then stasis. So no recovery. Nasdaq looks like this. We can look at the ETF version just to keep things consistent, and you can see it here. Here's the washout. You try to rally, it doesn't work. Again, and you're holding at the underside of whatever this range was. And all of these names, to some extent, start to look similar. Here's Tesla. One might argue it's holding up a little bit better, but a lot of these look the same. And the overall mags here, this is about as Nasdaq-ish as you might suspect. Range, washout, digestion.
Tesla reports Wednesday, Amazon Thursday.
I didn't really see any big surprises on the calendar today. Everybody that reported, is CSX out yet?
You had TSM today. They had a really good report. CSX, yeah, today is CSX. I'm not sure. I think they're after the bell.
They were after the bell. Let's see if CSX has reported, because that's, obviously there's tech names and then there's CSX. CSX is a bit of a different animal. CSX has reported, it's reported in line with expectations, 44 cents a share on earnings. That's exactly in line with consensus. A little bit down from the prior of 46 cents a share on revenue of 3.59 billion. A little bit lighter versus consensus. That was 3.61. No big changes here, seemingly. And CSX looks like it was up on the day going into this. See if there's anything after hours here. Anything? Yeah, so looks like CSX broadly liked it.
Tomorrow ends with American Express for the week. They're interesting in, you look at if charge-offs are increasing, but consider American Express typically has higher credit rating portfolio of consumers versus other cards. So if you see an increase in charge-offs there, a little concerning for middle class and upper middle class, showing some cracks in there perhaps.
And with that, since we don't have any economic data to watch, overtime is out of time. We're going to be right back here with macro money, so don't go anywhere. We're going to talk more about what these Fed speakers said today and why it was so weird that the markets didn't like it and what that means. But we're here Monday through Thursday, so overtime will be back next week for this conversation to continue. Brace yourself for the weekend if that's the next time you see us, because who knows what might happen over these next 24 hours. In the meantime, that's Dylan Radigan in Milan, Thomas Westwater in Chicago. I'm Ilya Spivak in San Francisco. Sit right there. I'll be right back. What a day it was in these markets. A fascinating display from the price action across major assets here, and one that no doubt we are going to be talking about for quite some time to come. We're going to unpack it all here on Macro Money. I'm Ilya Spivak, head of global macro here at tastylive, and once we look at these numbers, it would seem that what happened today was certainly unpleasant, but not any kind of catastrophic. But the circumstances that led to where we ended up today seem to lend credence to this idea that we are once again in the midst of regime change for these financial markets. And that's what we've been talking about all week this week. We, of course, don't have economic data of substance that is coming out because there's still this U.S. government shutdown that has taken the key economic data off the board here. And instead, we're just watching the price action and what it seems to imply as we get a sense for what these markets are now thinking. And so it's very, very interesting indeed to have what happened today occur. So in that context, so let's start here first and foremost with a look at the way that these markets performed today, and from there we'll try and get a sense of what exactly all of it means. Here is sort of the only indicator that we really have, then the price action itself. And on its basis, we end up with a story today that's obviously a risk-off exercise. I mean, that much is clear. Gold with another massive rally, 3.07%. Note that the dollar here is a little bit weaker. Euro up almost 0.5%, yen up a little bit more than 0.5%. The risk aversion here, very clear cut, even to crude oil and Bitcoin. They're down with stocks today. S&P off 0.8, almost 0.9%. NASDAQ down a little bit over 0.5%. Bonds up as rates slide across the curve. So very kind of straightforward, very obvious risk-off day, but for the dollar, which has a little bit of a downward wiggle. And that's where things get the most interesting. So here's the S&P 500, and this is really where we get this idea of regime change. So on the way up from these Liberation Day lows back in early April, we were clearly in some kind of a buy the dip mode. And really any kind of a bullish market environment seems necessarily sort of driven by this level of thinking. So if it is in fact a bull market, well, then you would expect the markets to kind of search out ways to make the news either irrelevant or supportive. And that's what we've seen. Every meaningful dip on the way higher here has been bought. And in between these dips, there is a slow, steady, but concerted effort to get further to the top side. And what's happened here since Friday seems to be something else entirely. And really, the past several days speak to this idea with great effect, especially today. But let's take a look here at what this chart seems to be showing us here. And what we find, zooming in, is here was, of course, Friday's massive washout right there. And since then, where have we gone? Nowhere. Every rally has been sold. So we end up right here where we try to bounce again and again. And every time that we get anywhere within the bounds of this dividing line marked by this consolidation range at the top, we get rejected. Now, what makes this particularly interesting is that, first of all, this is the same story across indexes, but more importantly, this sell-off ostensibly was about U.S.-China trade war escalation. It was triggered by the president going on Truth Social and throwing some bombs at China saying, we're going to do a 100% tariff on you because of your export controls on rare earths. And that, of course, follows a move by the administration itself to essentially say, okay, we had tariffs on Chinese entities and we had restrictions on selling things to Chinese entities. We are going to now expand these and plug essentially a policy gap to say this extends to all enterprises that are at least 50% owned by China. And that obviously makes for a much larger amount of entities that are being hampered by U.S. barriers. And so China responded with, okay, everybody that wants to export rare earths out of China now needs a bespoke license. So we're going to take this on a case-by-case basis and issue these licenses, which essentially means there is a very easy non-tariff barrier here where if you don't want to ship certain things to certain places, you just don't grant a license. So the president went back and threatened a 100% tariff as of November 1st. Markets freaked out. Okay, sure. Has that story become worse since? No. In fact, it's become a little bit better. Secretary of the Treasury, Scott Bessent, has been out there saying, ho, 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 we're going to get a deal. Trump and Xi are going to meet still on the sidelines of the APEC conference later this month. I know Trump said that the meeting was off, but it's not off, it's on. We're going to walk this thing back. Even the president has come out and said, I think Xi just had a bad moment. I think we're going to get a deal here. Everything is going to be fine. The U.S. Trade Representative, Jamieson Greer, coming out saying, hey, we're going to get a deal here. The meeting is going to happen later this month. Nobody freak out. And yet, we can't come back off this freak out here. And every time we do, we get stuck. Moreover, it isn't the names you would expect to be most hampered by a trade war that are front and center for the weakness. We have here NASDAQ, the Russell, and the S&P. And of course, we can see the NASDAQ is underperforming since the open on Friday, so since before the sell-off starts. The opening on the day of. NASDAQ is down 2.12%. S&P is down a little bit less than 1.9%. Russell is only down 0.5%. And that's something that happens today. Before today, Russell was actually up net of this sell-off. So this was Friday. We can see here. So going into Friday, this was the sell-off. Since then, Russell was actually up as of 2 days ago. But it's the NASDAQ on the losing end, which is an interesting sort of configuration for an environment where you'd think, oh, well, if there is a trade war, that's a risk to economic growth. That risk to economic growth should hurt the companies and the stocks of companies that are the most exposed to economic growth type of concerns. Companies that aren't cash rich, companies that are cyclically sensitive. That's the Russell. Whereas the NASDAQ is being powered by very cash rich, very large market cap, very deep pocketed tech names, which we saw in spades during COVID, don't particularly care even if the whole global economy stops. Because that's not how they make their money. So, and of course, to the extent that AI hopium is a huge sort of catalyst for the most recent run in NASDAQ and in tech names, it doesn't even depend on things happening now, so much as it is anticipating what will happen later. Once all of this building out of AI infrastructure actually turns into deployment and ROI. So it's very interesting that in the teeth of this sell-off, it's the NASDAQ that's getting squeezed the most. Almost as if the trade war isn't so much a catalyst for its own sake, it's a negative headline and an excuse for the markets to be selling in places where speculative exposure is most concentrated. Not so much where there's the greatest sensitivity to a trade war per se, but where the most speculative dollars sit. And that's, of course, in tech and the NASDAQ. So it would seem then from this level of thinking that what's going on here isn't really about a trade war. It's about de-risking portfolios. And that seems to be the regime change that's on display here. What makes this all the more fascinating is that the sell-off today, this rebound today in risk aversion that we see, this sell-off here, it starts not at the beginning of the day. Obviously, we were kind of drifting higher, but there is a specific catalyst here this time. And that catalyst, incredibly, comes from Fed speak and not of the hawkish variety. Fed Governor Christopher Waller was on the wires today. He's been one of the main policymakers calling for rate cuts. He was one of the two dissents in July. He was the first dissent in June, calling not for holding rates, but for cutting them. Not surprisingly, he was very dovish here. He is more incrementalist than Stephen Mirren. He's saying that we don't want to make a policy mistake, so we're moving in careful 25 basis point increments. But needless to say, the markets took these comments very seriously because he's one of the leading contenders to succeed Powell as Fed chair next year. Bowman is obviously also on that list. Kevin Hassett's on that list. Kevin Warsh is on that list. And for what it's worth, betting markets, Polymarket and Kalshi, they're saying that Hassett is the likelier candidate. Waller is somewhere third in the running, somewhere second, depending where you look. But clearly the markets think Waller is a stronger possibility than do the betting markets, because they responded very acutely to what he said. And what's amazing here is that they responded negatively because up until this point, again, regime change, we've been looking at dovish things being a risk-on catalyst, not a risk-off catalyst. So take a look at what Powell said, or what Waller said here. Fed interview process is going well. Had a great interview for chair. Cutting rates is the thing to do. Private sector data is consistently telling us a story of a weak labor market. Estimates for inflation are at about 2.5%, and nothing seems to jump. In other words, don't worry about inflation. The Beige Book is telling us the economy is not rosy and not booming. We may see weaker GDP at the end of this year. The neutral rate is about 100 to 125 basis points from here. In other words, we've got about 100 basis points just to get to neutral, let's say. And if you look at the Fed's most recent forecasting, here's the September SEP. There's 3 rate cuts here for 2025, so that's 75 basis points. A 4th one for next year, a 5th one for 2027. So in Waller's kind of frame of reference, this projection takes us to neutral over the course of next year and 2027 at this pace. But clearly the markets thought this was more dovish than that. Because if we look now, we see that for the first time in a while, in over a week, we have the probability on the board here, slight though it is, that later this month, we're not going to get just a 25 basis point cut. We're going to get a 50 basis point cut. And the likelihood there is about 5% But it gets spicier. Looking at December, the likelihood that it's a 25 basis point cut is actually down versus yesterday. And the reason it's down is because there is a probability increasingly, almost 20% in fact, that we're going to get a 50 basis point cut at either October's meeting, which would make this the 25 basis point move after a 50, or that December is the 50 basis point cut. And that's how we end up here. It is a big deal relative to recent expectations that we are now looking at about a 20% chance, almost. Let's call it about 18%, 17, give or take. That one of these meetings, either this month or next month, will be a 50 basis point cut. And of course, there's a slight less than 1% chance that both of them are going to be a 50 basis point cut, but that doesn't look like it's very serious here. But it is on the board now, which is an interesting development. So clearly whatever happened here was dovish. Clearly the markets responded, and clearly it was Waller they responded to because the timing seems to line up. What's interesting is that stocks sold off on this. Here's what happened with policy expectations. The markets are almost fully priced in for 3 rate cuts next year. We've got a net of 41 basis points on the board here, net of the 25 that we've already seen cut in September. So that means that we're basically a given. We're basically a shoo-in for 3 cuts, at least for this year. 41 basis points out of 50 more after September is an 82% chance that we're going to get both of these cuts. And of course, we can see from the specific sort of date-adjusted numbers that we just looked at, this and this, that it's even more than this would imply just looking at the contracts in their raw form. We have through the end of next year, in fact, priced in pretty much the midpoint for what Waller is talking about. If Waller says that we are 100 to 125 basis points away from the neutral level, then 114 basis points is right in the middle. And that's about what the markets are calling for. They're calling basically to get to neutral by the end of next year in Waller terms. What's more interesting yet is that the price action here seems to suggest that the markets now see rate cuts as evidence of bad things, not good things. Note here was the sell-off from the beginning of the year when the tariff scares begin. This is about the range top and bottom there at the beginning of the year. Right there. Here's the breakdown. That's the tariff scare. Notice that lines up with the beginning of a dovish shift in Fed policy expectations. Here's where that bottoms out with Liberation Day and the 90-day pause on tariffs. Notice that rebound runs out of steam here, just as you get back to where the sell-off started. That's right there. And everything since then, right up until these most recent peaks, has been, if it's more dovish, it is good for sentiment. But look at what's going on now. Once we get to this peak after September's rate cut, this is the cut and a little bit more dovish speculation, but not as much as the markets thought. And this is where the markets peak. So as we get more dovish now, markets actually go down, seemingly suggesting that we are in fact in some kind of a regime change, because what was good news from here to here now seems to be bad news. Now rate cuts are happening for the wrong reasons, one would surmise. Perhaps this is recession risk. Perhaps all this talk about a weakness in the labor market has people thinking, oh, well, there's an economic downturn that we need to be worried about. Looking at the dollar here, we can see, even though it's a little bit weaker today, as things were getting more dovish in this outlook, the thrust for the dollar has been up, suggesting that it's still something of a risk haven asset in this environment, today's price action notwithstanding. The economic calendar for the remainder of the week is quiet, to say the least. There's one more bit of Fed speak tomorrow. Otherwise, things are relatively quiet. The earnings front here today really telling us the risk-off story, not because we have a situation where things missed, and incidentally, we did have the results from CSX. They actually came out exactly in line with expectations. I just took the screenshot before they were out. It was exactly 0.44 for the outcome, so 44 cents a share. Right on the screws here, but nevertheless, everything down. Each one of these companies surprised to the top side, or in the case of CSX, met expectations, down across the board. Because it's a risk-off day and these things don't matter. Earnings just don't matter when there is a sentiment extreme like this. And what we end up with, of course, is still this sense, earnings-wise, that what we're looking at is an environment where the markets are rewarding positive outcomes to a much less of an extent than they have historically. Meanwhile, they're punishing negative outcomes more so than they have historically. And so, again, you get this clear sense that what you are looking at is a sentiment shift, a kind of regime shift in what is the market's default. So, absent news from April until these most recent tops, the name of the game has been whatever else might be going on, buy. Buy the dip. And what seems to be going on now is the inverse of that. Wherever else is going on, the default, sell the rip. And so positioning wise, I am still long the dollar, today's pullback notwithstanding. Still have this put vertical exposure in the NASDAQ and in the S&P. Obviously, you can see today that worked. They were down. Still have this exposure to the bonds. I'm glad I loaded up. It seems like we're going into a more dovish direction, so I'm still long the long end here. And still short crude oil, which seems to be now falling amidst these more growthy-looking concerns, and that continues to work. And that's macro money for today. As ever, we are here Monday through Thursday, so this is the last show of this week. We'll be back next Monday to do all of this again. I'm also writing for the News and Insights portion of tastylive.com and commenting at Ilya Spivak on former Twitter and on Blue Sky. If you're watching this on YouTube, like and subscribe. Happy trading. What a day, what a day. This is Overtime. I'm Ilya Spivak here in San Francisco. That's Dylan Radigan in Milan, Thomas Westwater in Chicago, and whoa, we got a conversation for you today. I don't even know what we're going to say, but looking at this price action, we're going to say something fiery, no doubt. Cuckoo birding and all. Gentlemen, how goes it?
It's going. Yeah. It's quite a day. I mean, across a few things, not only the equities, but the metals, you know, all of it.
It's a spicy kind of day. And it's a spicy kind of day for all kinds of reasons. It isn't just that we have a down day in stocks, and we can go right to the charts here. I just wanted to point out for you gentlemen the framework that we've been talking about here all week. This idea that, okay, so we had this massive sell-off ostensibly on trade war Michigas on Friday. And since then, the order of the day has been, give me a rally and I'll sell it. Because all of these attempts to try to recover, to try to buy this dip, they've all failed, one after the other. We get another big one today. So the most interesting thing about this price action seems to be that the trade war story hasn't gotten any worse, hasn't gotten any better necessarily, but all of the conversation out of Besant and Jameson Greer, the USTR, and all these other administration people has been an effort to calm things down and say, listen, it's not that serious. Nobody's going to go there and torch these talks between the U.S. and China. And the president himself even came out and tried to smooth things over. But we can't seem to get any momentum on a rebound, and the NASDAQ, of all things, is underperforming. Do you guys think that this is a trade war story at all?
I mean, I tend to think, I think today was the most interesting day yet I think for obvious reasons. And I think that what happened today very much validates what you have been asserting from the get-go, going back to last Friday, which is that the market is behaving this way because the levels are on a price extreme. It's overextended. There's lots of air pockets underneath this thing, and provoking it with anything is capable of incredible velocity to the downside.
Yeah.
And I agree with basically with everything that you just said, which is that one, it feels like that the ethos or the hypothesis of the market has flipped from, buy the dip, at least for the moment, to absent a real reason to go higher, I'm going to sell it.
It seems like
It's
that's
sort of like,
becoming a thing.
I need a big AI headline. I need a big Fed headline. I need it. Like now it feels like it's the other way around where it's like, listen, all else equal, sell it. As opposed to before last Friday, it really felt like, certainly for the last few months, all else equal, buy it.
Yeah.
And the only reason I can even begin to offer an explanation for that or to that or about that is it's a referendum on the price levels, which are on extremes. It may, if Vecchio was here, I bet you he'd say it's a referendum on seasonality.
Maybe.
And, our friend Andrew Ross Sorkin has got the crash book hot on the front page of everybody's iPhone these days. So 'tis the season.
Indeed.
It's an interesting moment. It's an interesting moment to take a mad dog put position, or at least sells maybe some call spreads on the NASDAQ and take advantage of the expanded volatility. So the more conservative maneuver, I would say, that I'm personally entertaining is NASDAQ call spreads. And then, the wild one.
Selling them, you mean?
Selling them, yeah. And then the wild one would be just to straight up buy puts, or at least put spreads, to try to mitigate the vol expansion well out of the money. I think that there's a higher chance than there has been that in the next 3 weeks, let's say, the next 3 to 4 weeks, even the next 2 weeks, that there's a barn burner of a sell-off that makes Friday look like a warm-up act, which is not a prediction. I'm just saying that the pot odds of something wild happening seem to have gone up. And I actually look at today's market action as much more concerning than what happened on last Friday.
I would agree. There's an interesting caveat here, but before I go there, Thomas.
Or for that matter, Tuesday. Sorry.
I agree. And there's a caveat here today that I'll delve into, but Thomas, share your thoughts here first. What is this telling you both about today and about kind of the landscape?
Well, today there's something that not too many people are talking about yet. It's on some headlines, but go to KRE.
Yeah. There was a kerfuffle today.
Yeah, there's a couple regional banks that made a bad
Zions,
loan.
I think, and one other one.
Yeah, two that made the same loan to a smaller bank that it went bad. I think it's something to do with fraud, something like that. But it's a pretty large loan. I think 150 million. But this is one of a few other bad loans, or loans that have went bad over the past few months for regional banks. And it's starting to paint a story of, I don't know if it's subprime lending, but lending that slightly riskier lending that sometimes regional banks do. And this also dragged XLF down a lot. I think XLF was one of the worst sector performers in the S&P 500 today. So it seems like the story now is just to sell these banks, get them off your books, and reassess the situation. Does that speak to something like more trouble in the economy amid these banks that are doing a bigger portion of their lending to consumers or to small businesses? So this is kind of adding to the fear narrative of an economic decline or some kind of prelude to it. So that I think hurt a lot more than just it being sector rotation or selling the rip. But it's interesting because it was a risk off atmosphere today. I mean, gold and silver told that equities down. So there's we're swinging back between buying and selling. It's FOMO buyers trying to come in just to buy the dip because buying the dip has been something that has worked in the past recently. But you never know if this time there has to be a time where you're going to get an extension to the downside. So what I've done is I've lined up my portfolio a lot, even though I wasn't exposed to too many equities before. But I've really taken down my amount of capital that's allocated to trades. And I think we might need to, I mean, tomorrow's Friday, it's before the weekend. I'm not too optimistic that, maybe we get a small bounce again tomorrow and then it sells off in the afternoon session going into the weekend just because people want to de-risk. What is Trump going to tweet over the weekend that you're not going to be able to get in and out of your trade? So I'm going to wait till Monday until I put some risk back on. I took one shot just to get some exposure in AMD. I sold a put spread. That's pretty much all I did today. I tried to get that iron condor back in oil, wouldn't fill again. So that's the second day it hasn't filled. I don't know why, but yeah.
It's an interesting setup. I'm glad you pointed this out. In fact, this is a chart from Zero Hedge. Every now and again, we do look at Zero Hedge. Every now and again, they do have that right story that no one's talking about. And this is Zions Bank Corp and Western Alliance. To your point, Zions Bank Corp fell after a $50 million charge-off for a loan to a wholly owned subsidiary, California Bank and Trust in San Diego. And Western Alliance Bank Corp took a dirt nap also. They apparently are saying that some borrower of theirs, quote, failed to provide collateral loans in first position, which is basically a fraud allegation. So not great. And very much a part of this story. The other part of this story that's very interesting was the Fed speak part, because that too has a role to play here, and you can see it when you look at these Fed rate cut odds and the way that they've developed. So first, let's take a look at October. And obviously, we're still very much in the high 90s here for a 25 basis point rate cut. But look at this little guy right here. This is now the probability of a 50 basis point cut later this month, which is now up to 5.3%. So you take that 5.3 together with the 94.7 here, and uncertainty about this rate cut is off the table. It's 100% likelihood that we're going to get a cut this month. It's a given now. And what's interesting is that we got out to maybe a 50 basis point cut. But hang on, there's more. Here's December. So for December, we're still looking 81% chance that we'll get another cut. So the third of the year, the second after September's. But look at this. We're looking at an 18% probability now that either October or December give us a 50 basis point cut, and a minor, less than 1% chance that we're going to get 50 basis point cuts at each one of these meetings. And that's obviously unlikely. But nevertheless, the market went into a really dovish kind of space today. And when you look at sort of where all of this comes from, and what all of this does to Fed policy expectations, not just for this year, obviously, but also for especially next year, because that we're going to have 3 cuts this year has been a given for a while, where there's 25 basis point one at each meeting after September. So September, October, December. That was in the Fed's summary of economic projections. The market's already had it mostly benchmarked. That's not controversial. What's controversial is what we now see as meaningful possibility that it's not going to be 75 basis points in total. It's going to be 100. That is to say, one of these next ones is going to be a 50 basis point move. But also, next year is going to be more dovish than we previously thought. Here's the SR3Z6 contract. So this is the price on interest rate futures for December of next year. And you can see here, massive move higher in the price, which is the same thing as a move lower in the yield. And so this is more rate cuts. Now, how fascinating is this after months and months and months of listening to anything dovish being a risk-on, buy them if you can do it kind of a situation. The market has loved anything that smells like rate. Once the kind of nonsense after April